Hi everyone, good morning. You all can see me, see my screen. Can you all hear me clearly? Hit the like button if you all can see me, or at least send me a thumbs up or write okay in the chat box. Is my voice audible? Screen you all can see well. Okay, very good. Welcome everyone once again for our marathon on financial management. Okay. So, as I have told you all earlier, let me just repeat myself once. Since we are doing this financial management marathon for the CS Executive, it is for both old and for new syllabus. If you have missed my previous marathon on the other chapters which are important I have taken, please go back and revise those, go through them, and you will be solved and sorted for this current June exams. Okay. So, just as to give you all a reminder of my schedule, we have done a marathon on 6th, we did it on 8th. Today again we are coming together and going to solve two important chapters, which is time value of money and capital budgeting. Okay, so stay with me, pay attention, keep your calcs, pen, paper, book, everything ready. I'm going to make it very simple for you all, these two chapters. Okay, whatever worries you all have of these chapters, they are going to ease out by the end of this lecture. All right, and then again we are going to meet for the corporate accounting marathon next week, same time. Okay, we will be doing all the important chapters from the exam point of view, which you will cover 80% of your paper, similarly like how we did for FM. Okay, and again, for those who have joined today, this is a dream batch. It is a gift from our side, from my side to all of you. Go and subscribe to this dream batch. It's for minimal cost of 99 rupees. You will get access to all my lectures, all the sums, everything what I have covered, even those lengthy sums, MCQ formats, everything, exam questions, the entire detailed lectures with additional practices covered in this dream batch. You will have access to it until your exam start. So if you want, you can start now also. It is not too late. It is never late unless you give up. Okay, so please go ahead and take the most advantage of this. Share it with your friends, let them also come to know, and help us reach out to everyone. All right, so we are going to begin today with time value of money. Okay, we are going to start with time value of money. Now, before I begin with the explanation and then starting, we are going to do the theory. We are also going to do the sums. What is going to ask in theory, I am going to give you importance of that. Just do that much from your theory point of view. Rest everything is more practical in time value of money. Okay, you have to know how to calculate the value of money today, tomorrow. All right, so before I start, just a quick wakening up if you all have gone to sleep. What do you all understand by time value of money? Approximately 3 hours. Today somebody is asking me how long would be the marathon. Approximately 3 hours, considering time value of money for 1.5 hour, again capital budgeting for another 1.5 hour. Again, with those two chapters, I've clubbed certain few past exam questions also. So we will be solving them. Don't worry, it's okay. So tell me, what you all understand by time value of money. Ever you all have done something in college or anywhere else about time value of money, or what is your basic understanding when this term comes, time value of money? Write it in the chat box. Okay, someone has told me it is the value of money in future. Okay, all right, if even you all don't know, it is not a problem. I am here to teach you all that only. Okay, but I just wanted to know whether you are all paying attention or not, so at least we can go ahead with that. Okay, someone has told me it is the change in the purchasing power of money. Value of money today is not the same after given period of time. Fantastic. That money value won't be the same as now. Very good. Interesting. All of you all know it, yeah? Time value is where we have certain amount right now that will not be the same amount after certain period of time in future. Very good. Okay. So now let me also explain you all in very simple form. Basically, when I am talking about time value of money, at that time we are considering the value of money adjusted with the time. Time is money. Okay. So if I am saying that I am having rupee 1 today, present value. If I am going to keep this rupee 1 for a period of another 1 year, the value of that rupee 1 is going to change value. Okay, why will it change? Say this rupee 1, instead of keeping it in my desk or in my cupboard, I would have invested this rupee 1 at 10% of interest rate in FDs, or I would have invested this rupee 1 in the market. It would have fetched me 10% of some kind of income, growth in the money. Correct? So obviously that 1 rupee at the end of the tenure would become 1 plus 10%, 1.10. Exactly, correct. So time value of money says that whatever is the present value of a given money today doesn't stand the same even in future. So we are going to talk about present value, we are going to talk about the future value. Okay, we are going to talk about opportunity cost or interest factor, discounted rate factor. All this is what? This rate at which the money grows. Okay, why? Because this particular rate is the one which gives you the opportunity cost involved for the value of the money which is there today, and it will not be the same tomorrow. So if I want to earn 10,000 rupees at the end of 5 years, this is my goal. I have set a goal that I should be able to earn, my money should be able to earn 10,000 rupees at the end of the 5 years. This is what I require. So what should I invest today? Is the question. Okay, so according to this factor of time, when you adjust the money required today or tomorrow, we talk and we say that it is time value of money. Now this is a very important financial decision. If I am sitting now and I am saying, okay, tomorrow I am going to make a profit of 10,000, next year again 10,000, another next year 10,000, but that is next year, no, after a year. What is the value of that 10,000 today? What is the value of that 10,000 which you are going to earn in 2 years today? Okay, so that is what is very important in case of time value of money. So let us read this very easy basics. Okay, see, the concept of time value of money is based on the idea that money available now is worth more than the same amount in the future due to its potential earned returns. Obviously, okay, if I will say 1. 1 rupee is going to go and increase at 10%, so it is going to become 1.10. People generally prefer to have money now rather than later. Of course, money can be invested to earn that return, making it worth more in the future. So during inflation, money today has more purchasing power than that in future. TVM, time value of money, is a crucial finance as it helps in comparing the valuing cash inflows at different times in different years, which is essential for investment making decisions, valuing securities and more. Okay, so basically, what are the key important points? This is what is important for time value of money. Money's today worth is more than the same amount in future. Investing money sooner rather than later, it is how you will grow. You will be able to avoid your missed opportunities. TVM considers the amount, its potential future value, expected returns, and the time period involved. In savings, how often interest compounds also affects the growth. Inflation diminishes the future purchasing power of money. Right. So today, if I in during inflation, today I will be able to purchase more. Tomorrow, that power of money is going to reduce. Okay, I will not be able to purchase, like say for real estate, what we were able to purchase 10 years ago, with that same amount you will not be able to purchase anything today in real estate. Right. So that is what we are considering with the period. Okay. Now in time value of money, there are four things which we are going to do. Okay, four important things. First is simple interest. Okay, you have kept some money in the bank, you are getting some interest, then you say compound interest. Okay, third and fourth is the one which is little vast. One is present value, how to find the present value of a given future value, and fourth is how to find the future value of a given present value. This is what is important from this chapter. Okay, stick to what I am doing. You will be able to easily solve any questions asked. Alright, so now let's begin. Compound interest and simple interest. We all know what is simple interest, right? Simple interest is calculating the interest on the principal amount, okay, considering the time. Here, the interest amount does not change. Okay, every year you will keep getting the same interest amount. Why? Because it is calculated directly on the initial investment. So say suppose you have initially invested 1000 rupees. Interest rate is 12% per annum and the period is 5 years. So, interest will be calculated on your this initial investment of 1000 at the rate of 12%. I have converted 12% into decimal. In case of time value and capital budgeting, when we will solve, you all will notice that we are converting the rate of interest, okay, in decimal always. It makes the solving very simple. So 12% is basically 0.12 for a period of 5 years. My simple interest is going to be 600 rupees. So at the end of 5th year, I will get 1000 plus this 600, 1600. Clear? Simple interest, they really don't ask. Okay, but you all have to know the concept of simple interest. I have explained it. I have given you one illustration. Next is compound interest. Here we had done it in remember we had done compound interest even in case of when we were doing working capital sums, factoring, correct? So over there also I had explained you compound interest means what. Here even the interest amount for each year earns interest. Okay, it is added to the principal. So if today I have invested 1000 and at the end of the year I have earned 100 rupees as interest, in the second year interest will be calculated on 1100 and not on 1000. Okay, so the interest amount will keep changing. Rate of interest will remain same. but the amount on which interest is calculated will change. Okay, so it is an accumulation of interest over the previous period. Okay, so compound interest significantly increases the money over the time as compared to simple interest. Obviously, because here my interest is also earning interest. Correct? So the formula for simple interest is very easy. You all have to remember all the formulas. Okay, very simple. It is amount for finding compound interest. It is compound interest is equal to amount principal into 1 plus R. R is the rate of interest. N is the number of years, times at when the interest is compounded. Sometimes interest is compounded once only in a year. Compounded means once only you get that interest. Calculated once in a year. Sometimes they compound it twice. Sometimes they compound it 4 times. Semi-annually, annually, quarterly, it can be there. Okay. And T is the time the money is invested or borrowed for in the years. Okay, so now let's understand the formula with the help of an example. Same example I have taken. We have an amount of rupees 1000. Okay, principal amount is 1000 rupees. Interest P is 1000. Interest R is 12%. N is 5 years. Okay, using the compound interest formula, I want to find the amount of compound interest. So it will be the amount of compound interest. Compound interest amount will be principal into 1 plus the rate of interest upon the rate of interest upon N. N is the number of time interest is compounded. Nothing is mentioned, that means only once the interest is compounded. And N into T means the number of times interest is compounded into the years for which we are calculating. How many years it is there? For 5 years it is there. Compounded annually. Compounded annually. If nothing is mentioned, we will always assume it to be compounded annually. Otherwise, they will always tell you it is compounded semi-annually or quarterly. We will always come to know what is N into T in that case. Okay, since it is compounded annually, I'll divide only by 1. Now, when you will do this, you will get 1000, 1 plus 0.12. 0.12 divided by 1 is 0.12. The whole thing raised to 5. Now, how to calculate 1.12 raised to 5? Basically, you are going to do 1.12 into 1.12. Sorry. Keep doing this 5 times, right? 1.12 into 1.12 into 1.12. I will show you one small shortcut for this. You will do 1.12 into 1.12. Since it is raised to 5, you will press equal to sign 4 times after this. Okay, I am writing it and I am showing it to you. Do 1.1, take 1.12 on your calci. Multiply that by 1.12. Okay. Then press equal to times 4 times. Equal to sign 4 times. If you all can see here, 1.12 into 1.12. 2 times this first I have written. Now since it is raised to 5, I am going to press equal to 4 times. 1, 2, 3, 4. 1.7623. Okay. You can sit and do 1.12 into 1.12 into 1.12 into 1 the number of times, or else simple. First multiply 1.12 into 1.12 and then just press equal to sign 4 times. 1 less than what is the raised to. Okay. Once I have got this value, I will just multiply that by 1000. So I will get rupees 1762. Okay. So basically the entire amount. So the interest amount is different. The entire interest will be how much? Total for the period of 6 years, it will be 762.32. But the amount which I will get, it will be how much? It is going to be 1762. 1000 plus 762. So I am calculating the whole amount only together. I am taking the entire amount. For formula for compounded interest, what will be my amount? It will be, this is the interest. How to calculate compound interest? So basically it is P into compound interest. A is equal to P into compound interest. What is the compound interest? 1 plus R upon N, the whole raised to NT. So you multiply that by the help of the principal, you will get the compound interest amount, full value. So when you are putting 1000 rupees at compound interest annually over a period of 5 years, it will grow and become 1762. If you compare that with simple interest, we got only 1600 rupees. Obviously, compounding will give you more return as compared to simple interest. Clear, everyone? Understood? Now, based on this compound interest, we will try to find the present value. Okay, let's see. Now, I am going to the concept of present value, and then last we will do the future value. In compound interest and simple interest, this is it. They cannot ask you anything more than this. Okay. There are certain sums which we are going to do. Okay. So, all of you all have got it, right? Next. Present value. Now, what do we understand by present value? We all just spoke about that. Present value means it refers to any amount, the value of it today, of receiving specific amount of money in future. So if I have a goal of receiving 10,000 rupees after a period of 5 years, I am going to invest it at the rate of 10%. How much will I have to invest today, presently? How much? This is what I want to find. Okay, it is based on the idea that the money available now is more valuable than the same amount in future because it has a earning potential. Okay, so now reason behind the present value, money today can be invested, earned returns, thus it grows over the time. Present value is always less than the future value if interest rate is positive. Okay, now example. Say same thing. See, like how I have given you an example here. They are saying if you want to receive 15,000 in 5 years and you can earn at the rate of 12% return annually, you might ask what amount you want to invest so that you can achieve this sum in future. So you will calculate. Okay. So this is an important decision which you have to take. Okay. 12,000 today or in 2 years. Taking the money today is preferably because it can be invested to exceed that $to 12,000 in 2 years. There is a interest rate which is affected, correct, which is there in case of present value. Now see this formula. Present value of a single amount. How will I calculate present value of a single amount? It is future value. This is the formula. Okay, future value, present value is equal to future value into 1 upon 1 plus interest rate. It is raised to n. Okay, this n is always raised to. It is not a basic multiplication. It is raised to. I means the rate of interest in decimalized. Okay, n is the number of periods. This we have to remember in case of present value formula. Okay, compound interest also we did it. Now present value we are doing it. Okay, then in the end, no, we will write all the formulas in one page. Okay, so that we know, we'll revise it. Correct. Let's understand this. Illustrations and solving is very small. Suppose a company is expecting to receive 8,000 after 5 years. Calculate the present value if the current market interest rate is 12% and it is compounded annually. We need to know this, how much it is getting compounded at, because twice or once or 4 times we need to know this. Okay, so as per our example, we all know that future value given to us is 8,000. Okay, I is 0.12, right? N is equal to 5 years. Now just put this in the formula. Put this in the formula. Present value is nothing but, you also please kind of solve it along with me. Okay, future value into 1 upon 1 plus I raised to n. Okay, future value is 8,000 into 1 upon 1 plus 0.12 raised to n is how much? 5 years. It is raised to sign. Raised to 5. Okay, so first calculate this. Keep this 8,000 over here. First calculate 1.12 raised to 5. We just did it, no? How we will do it? 1.12 into 1.12, and then we will press equal to sign 4 times. You will get 1.7623. You got the answer? 1.7623. Same thing like what we did last time. Now then 1 divided by 1.7623 is 0.5764. Do it on your calci. .5674. You can take it up to 4 decimals, 2 decimals if you are rounding up. Okay, so present value of that future value of 8,000, presently I will need 4,540 rupees. Only then in 5 years at a rate of interest of 12% it will become 8,000. Okay, clear? I am going really very slow so that you all can understand. Next question, we'll move. See, what is the present value of rupees 1,000 received in 2 years if the interest rate is 12% per year discounted annually and 12% per year discounted semi-annually? I will do this discounted semi-annually for you. Discounted annually, at least you all do it and show it to me. Okay, this one. I am not going to show you all the solution. Come on. Discounted annually 1,000 rupees for a period of 2 years. Semi-annually I will do it with you. Write it down, no? Future value they have given is 1,000. Okay. Then N they have given you 2 years and rate of interest I is 0.12. Put that in the formula. Keep writing the formula so you will remember. Present value is nothing but future value into 1 upon 1 plus I the whole raised to n. Come on, now solve it. Give me the answer. Yes, for semi-annually also it is very easy, but for compounded annually, what is the answer? Very good. Somebody has already answered. 797. 797 is the answer. Okay. Now, for compounded semi-annually. See, the solution is here. 12% per year discounted annually. 1000 into 1 divided by 1 plus I raised to 2. It is raised to 2. So easily, no? You can just get this answer 797.19. But if it is discounted semi-annually, then your amount is 1000. Okay, but your I, since it is discounted semi-annually, means you are not going to get 12% 2 times in the year. You will get 6% half yearly. 6% in first half, 6% in second half. Discounted semi-annually means what? That 12% interest you will get 2 times. Okay. So 2 times when you will not get 12%, 12%. You will get 6% and 6%. Okay. So basically your I will be 0.12 divided by 2. And your N will be how much? Your period, 2 years, into how many times it is going to get discounted? Twice. So your N is going to become 4. Now put this in the formula. Present value is equal to, what is the future value? 1000. Okay, into 1 upon 1 plus I, over here it is going to be 0.12 divided by 2. 0.06. The whole thing will be raised to 4. So basically 1.06 into 1.06, press equal to signs 3 times after that. For this, no, I am writing a 1.06. 1 plus 0.6 is 1.06. 1.6 into 1.06 equal to sign 3 times. You are going to get it as 1.2642. No, 2624 it is. 2624. Now do 1 divided by 1.2624. You are going to get it as this here, 1000 into 0.792. Just multiply. You'll get this answer. Now this point decimal answers, yes, it can be a little different. You can write approximately, or you can take up to 4 decimals. You will get the most approximate answer. Okay. And for MCQ papers, you all will have the right choice to choose from them. Clear? You're cool. I can move ahead. Compounded semi-annually understood. Nice. Sure. Next sum. Okay, now try to solve this. Ramesh wants $2,000 3 years from now. Compound interest rate is 8%. How much should he invest today? If nothing is given, interest is compounded annually. Correct? So everything is given. Just find the answer. I have put the answer also. Just check whether it is right or wrong. Write down the formula. What is the formula? Present value is equal to future value into 1 upon 1 plus I. Why do you think I am writing the formula again and again? So that we know it, we remember it. Okay? Because there is not only one formula here. There are many formulas which we will have to do. So other formulas will also come, no? Present value of one amount we are doing now. What if they have given you uneven series, which is the next? Then we have to do future value also. So you need to know the formula. Then we did compound interest also. Okay. Next one. I'm moving to the next question. present value of an uneven series. Now uneven series means what? That if a company has invested into, say, some project, okay, they have an investment made in a project. Project name is project A, and they know that whatever is the cost is, say, around 10,000 is the cost. Okay, and this project is life is 3 years. Okay, listen to me carefully. Then you write whatever you all want to. I'll give you 30 seconds to write. Listen to me right now. So this project A, for a period of 3 years, the cost to the company is 10,000. Now if I am doing any investment, I have to get something in return, no? So say if I am doing this particular investment, and in this 3 years, first year I was able to make only 3,000, then I was able to make 2,000, and in the 5th year I was able to make 5,000. Uneven series, uneven returns. Okay, so here then how do we find the present value of each future series? It will remain the same, but I want to find it out accumulatively. Total present value today for all this uneven series of ununiform cash flows. It is also known as non-uniform cash flows. Refers to calculating the current worth of a series of a future flows. Series, okay. This is a common in real life scenarios where your payments, investments, returns are not the same in each period. Not necessary I'm going to earn 10,000 profit every year. Today, this year 10,000, tomorrow it might be 12. Next year I might go to 8,000. So it is going to be uneven in nature. So present value then in that case is calculated, easy formula, cash flow for that specific period, whichever year, 1, 2 or 3, divide that by 1 plus r raised to n. Okay, this will be our formula. So for each series we will calculate, and then we can just add it. R is the discounted rate or the interest rate period, n is the number of period. Okay, so we will have to first take up an example in order to understand this. Suppose you expect to receive the following cash flows over next 3 years, and you want to calculate the present value at a discount rate of 10% per year. Discount rate means what? Interest rate, coupon rate. Okay, year 1 I'm going to get $1,000, year 2 1,200, year 3 1,500. I have to find the present value of all this uneven series. So first I will find the present value of year 1. What is the formula? Present value is cash flow upon 1 plus I raised to n. Right? So for my first year my n will be 1. For my second year my n will be 2. And then for my third year my n will be 3. Amounts they have given me. Year 1 my cash flow is 1,000. 1,000 divided by 1 plus 0.1, because the rate of interest or discounted rate is 10%. So basically my I is 0.10. Right? So for first year n will become 1. So 1,000 divided by 1.10. So I will need, present value will be 909. Then the second year ending, I am going to receive 1,200. So second year I am going to receive 1,200. So for today, how much is that 1,200 valued at? 2 times I will have to use this discounted rate. So therefore n is 2 year. So today 1,200 valued after 2 years, today's its value is 991. And then in the third year I am going to receive 1,500. But at the third year, no. So today what is the value of the third year end? So I will discount, the n will become 3 times. The discounted rate is in the effect at 3 times, no. So it will be 1,500 divided by 1 plus 0.1 raised to 3. Okay, then the calculation is very easy. Nothing you have to do. Then you have to just add P1, P2, P3. You will get the total present value of your future value. So total present value, when you add up, you get 3027.85. So this total, it is approximately, it is represents the current value today of receiving those future payments, which is adjusted with 10% annual return rate. Okay, right? Okay, now coming to present value, third. Okay, so we did basically present value of a future value, future money given, present value of uneven series, cash flows. Now present value of an annuity. Okay, what is the meaning of an annuity? Anything, any payment which is received, okay, regularly. Okay, so annuity is same thing like say interest, or you are paying insurance premium, rent you are paying. Okay, annuity. So present value of an annuity is the current worth of the series of equal future payments. Future payments are equal in nature. They are discounted at a specific interest rate. Okay, so you have to determine the future payments worth today, considering that time value. Okay, so even in annuity, you have annuity which is ordinary in nature and annuity which is due in nature. Now basically ordinary annuity means what? Here the payment is made at the end of the year. Best example is FD. You keep any money in the FD, you will receive interest at the end of the year. Debentures, end of the year. Bonds, at the end of the year. When the year gets completed, you get the returns. Annuity due means what? Here the payments are made first. Like say for example insurance premium, you make at the start of the year. Rents at the start of the year. Okay, so this is the only basic difference between annuity ordinary and annuity due. Therefore the formula also changes, because if you see in ordinary annuity, there is a basic calculation, but in annuity due there is 1 year extra, no? Because the payments are made at the beginning of the year. Okay, so for formula for calculating the present value of an ordinary annuity, payments were made at the end of each period. The formula is PV, present value is nothing but P into 1 minus 1 plus rate of interest raised to minus n upon r. Now whenever we have this raised to minus n, we will just calculate it simple with n only, and then we will do the reciprocal. This is your maths, school maths. Okay, but I will explain you. But let us understand the formula. Okay, annuity which is an ordinary annuity, okay, where the payments are made at the end of each year. There the present value will be the principal. P is the amount of each payment you are making every year. So each year you are making 10,000 payment into 1 minus 1 plus r. Okay, this 1 plus r you have to take it raised to minus n, the whole thing, then divided by the rate of interest. Okay, so P is the amount, R we all know it is interest rate, N is the total number of payments. Okay, see the illustration. Suppose you are set to receive $1,000 each year for next 5 years, and the discount rate or the interest rate is 10% per year. Calculate the present value. Okay, so I am supposed to receive 1,000 every year. So basically present value will be equal to the payment which I am going to receive every year into 1 minus 1 plus I raised to minus n. Instead of n you will say minus n, divide by r, I. I or R, whatever. I write I because I convert it into decimals. Okay, so how will you calculate this is, first put all these figures in the formula here. Nothing I have done. 1000, 1 is the in the formula, minus 1 plus 0.10 raised to minus 5 because n is 5 raised to 0.1. Now first calculate 1 plus 0.1 raised to minus 5. How will I calculate this is, I will do 1 plus 0.01, the whole thing raised to 5 first. So that is 1.10 raised to 5. How will I calculate this? 1.10 into 1.10 equal to sign, then I'll press 4 times. Do it. 1 divided by 1.10. 1 into 1.10. 1.10 into 1.10 equal to sign 4 times. Okay. I'm going to get this as 1.61051. See, all of you all got it? 1.10 into 1.10 and then press equal to sign 4 times. You will get 1.6105. Now this minus sign means reciprocal. Reciprocal means just take 1 and then divide this by this answer, 1.61051. Okay. Just divide that by the answer which you got by 1.10 raised to 5. Okay. So 1 divided by 1.61051. You will get this answer, 0.620921. Correct? Simple. Then now put this in the formula. 1 minus 0.1000 PV, present value will be 1000. Okay, into 1 minus 620921. Now that when you will divide it, 1 minus this and then divide by 0.0, you will get 3.79079. Multiply that 1000, you will get the present value. Okay. See, then I have given you an explanation down. So this value represents the current worth of receiving $1,000 at the end of the next 5 years. Okay, considering a 10% annual discount rate. This calculation is crucial for financial decisions like valuing retirement annuities, loans, and other financial products that involve regular payments. Okay. Clear? Anyone who has not understood anything can put it in the chat box. Annuity can be the same amount every year. Annuity can be different amount also every year. That we did know. Uneven series. Okay, uneven series. Even series, uneven series, it's the same thing. Okay, but this was the present value of an annuity, ordinary annuity. Okay. Now let's consider another example involving present value of an annuity. Suppose you are considering to purchase an investment, investment that will pay you $2,000 annually, same amount, for the next 10 years. Okay, the annual discount rate is 8%. Okay, so they have told me my payment is going to be $2,000 for the next period of 10 years. Every year I'm going to receive $8,000 and my R is 8%, so my I is 0.08. Same formula, using the present value of an annuity formula, I will get present value is the P, the whole thing 1 minus 1 plus R upon R raised to minus N. So this 1 plus 0.08 raised to N, calculate this first. Once you will calculate this, no, make it 1.08 raised to 10. Calculate this first. Then your problem will become very easy. Equal to 9 times you will press. 1.08 into 1.08, 2, 3, 4, 5, 6, 7, 8, 9. You will get this answer as 2.15892. Then just do it a reciprocal so that this minus sign is adjusted. 1 divided by 2.15892. You will get this answer 0.63193. Then the calculation is very simple. Okay, amount will come as $13,000. So basically receiving $2,000 for the next 10 years. Every year you are going to receive it at the end of the period. So today it will be the value of that entire amount which you are going to receive. It is going to be of $13,000. Fine, clear? Okay. Now present value of a perpetuity. What is a perpetuity? Means it is again stream of identical cash flows which are going to come indefinitely. You don't know for how many years. Okay, for 10 years or for 15 years or for what, you really don't know that. Okay, so here it is used to find out the present value of those perpetuity amount which you have done in investments, like you have gotten stocks, bonds, okay, real estate, any other kind of any financial asset which you have. Okay, a perpetuity is a type of annuity that pays an infinite series of cash flows. Unlike typical annuities, perpetuities have no end date. Okay, so there are two types of perpetuity calculation. One is standard, okay, and then the other one is growing. Standard means it is like the same thing is there for over all the years, you know, indefinite years. And growing means there is one growth factor which is there, no, like how we did dividend grows every year or every 2 years or 5 years. Some percentage of growth we will expect, right? So this is a very easy thing. If you are asked to find standard perpetuity, present value of standard perpetuity is nothing but investment cash flow, that identical cash flow received in each period. Just divide that by the discounted rate, interest rate. Simple. You have to just do the identical cash inflows divide by R. That will be your present value of standard perpetuity. See example. I have done the example also. And in case of the growth rate, okay, if the cash flows grows at a constant growth rate G, the present value of the formula will be adjusted with respect to the growth rate. So you will do PV factor will be identical cash flows upon R minus G. The amount of interest or the cost or discounted rate will reduce, no, due to the growth. Okay, you will get growth period every year or every 2 years, whenever. So if you're asked to find the standard perpetuity value of perpetuity here, suppose you're supposed to receive $1,000 every year indefinitely. There is no N over here. Discount rate is 15%. The present value of this perpetuity will be 1000 divided by R. Okay, 1000 divided by 15%. How much it is? 5%. Sorry, 1000 divided by 5%. 20,000 present value. And if it is a growing perpetuity, they are saying expected to grow by 2% each year. So here now your discounted rate, your interest rate will reduce by 2%. Minus that by 2%. Okay, so your present value is going to be 33,333. Okay. Okay, so these formulas show that even infinite cash flows can have a finite present value due to the discounting factor. The greater the discount rate, the less valuable the future cash flows are. Less valuable, obviously. To see this 33,000. Okay, here it is 33,000, in here it is 20,000. 20,000 today's investment is okay, but if you say 33,000 I have to invest today, today's value, it is more, no? So it is less valuable for future, no? 33,000. See, the greater the discount rate, the less valuable the future cash flows are. And conversely, the lower the discount rate, the more valuable they are. Okay, the growth rate in the growing perpetuity further reduces the effective discount rate and therefore increasing the present value of the future cash flows. Obviously, the growth rate is reducing the discount rate. Therefore, your present value will always be higher in a growing perpetuity. Okay, as compared to a standard perpetuity. The more will be the discount rate, the less the present value is going to be even low. The discount rate is higher. Okay, so present value, perpetuity, present standard perpetuity, and you have the growth perpetuity. Okay. Now see this. One small example again. Magnificent Limited pays $2 in dividend annually and estimates that they will pay this dividend indefinitely. There is no period. How much are investors willing to pay for this dividend if the required rate of return on that investment is 5%? So I will try to find out, as an investor, I will try to find out today's value in order to get this $2 dividend yearly. Okay, infinitely, and expected rate is 5%. So 2 divided by 5%. So I am ready to invest $40. If the stock price is $40 or less, as an investor, I will invest it. Okay, present value. Clear present value, everybody? Simple interest is done. Compound interest we did. We have done present value. Okay, so present value of single amount. Then we did present value of different amount. Okay, uneven series. Then we did present value for annuity. And then we did present value perpetuity and present value standard perpetuity and growing perpetuity. Alright. Any doubt? You all want any explanation so far? Shall I move ahead? Okay. If there is any doubt, you all can definitely put it in the chat box. I will solve it again for you all. Okay. So don't worry. Next, I am starting with the future value. Same thing we will do now again. Future value of a single amount. Okay. So now future value means that if today I am having rupees 1, at 10% it will become 1.51 after 1 year. Okay, so this is what I am going to do with the future value. So future value means the amount to which the investment will grow if there is a given interest rate or discounted rate. Single amount refers to a lump sum investment, okay, for a given period, say 1 year or something, okay, or whatever, okay, whatever period is there, we will calculate the future value for that period. So future value formula is very easy again, okay, it is in investments into, yes, it is investments into this formula. I think it is a little wrong, yes, means this t no is not on the raise to, that is why, that's the only problem. Investment into 1 plus I or R raised to t, investment amount, I is the investment amount, okay. So future value of the invested amount today into 1 plus I raised to t, t is the number of years, R is the interest rate, I or R is the interest rate, okay. So future value is the value of a current asset at a future date based on an assumed rate of growth, okay. It is important for the investors and financial planners so that they know that whatever investment today they are making, how much worth it will be in the future, okay. So let's start and do an example. Only this amount of the explanations which I have given in theory form, just do that much. Once you have solved a sum, no, you will be able to write the theory easily. Whenever they ask you any theory question, okay, say for 2 marks, 3 marks, give a small explanation, write the formula, finish, you will get full marks there, okay. This is how you attempt the theory part also of financial management. So now question number 10. You are scheduled to receive 13,000 in 2 years. When you receive it, you will invest it for 6 more years at 8% per year. Okay. How much will you have it in 8 years? Means what will be the future value in 8 years? So my investment amount is going to be 13,000. I will be 13,000. Okay. In 2 years, I am scheduled to receive it. Now this 13, I am going to invest it for 6 years. Okay. So T is going to be 6. And I is going to be how much? 8%. So 0.08. Right now 0.08. So what is my formula? My formula for future value is equal to investment into 1 plus I raised to T. Here my investment amount is 13,000. Into 1 plus I is 0.08, raised to T is 6. So 13,000 into 1.08 raised to 6. How will I solve 1.08 raised to 6? 1.08 into 1.08. Then press equal to sign 5 times. Come on, do it. Are you getting something like 1.5868? Multiply that by 13,000. Approximately you will get this answer. On the calci only. I am not even making it 4 decimals. Directly on the calci only, multiply it by 13,000. You will get this approximate answer. Cool. Simple. Future value. Come on. Next sum. Next sum here. It is like those that, how we had unequal returns, uneven series in present value, something like that. Okay. Uneven returns are there over here. That is why we have calculated it in this manner. Okay. Amount is same. Investment amount is rupees 1 lakh for 15 years. Okay, the current 5-year rate is 6%. Rates for the second and the third 5-year periods are expected to be 6.5% and 7.5%. So what have I done is, my N is actually 15 years, but I have split it into period of 5 years, 5 years, 5 years. And I have made 5, 5, 5. Why? Because for the first 5 years, the rate is 6. Next 5 year it is 6.5 and then 7.5. So you can do it for, calculate this, put this formula for each and calculate. Investment, okay, into 1 plus I, for I 6% and the T will be 5. And then add all. What I have done here is, future value is nothing but the investment amount into 1 plus I raised to T, it is, right? 1 plus I raised to T. So I have multiplied all together only. So here I is 6%. So 1 plus 0.6 will be 1.06. Then it is 6.5. So 1 plus, it is 6.5% in the second 5 years. And in the third 5 years, it is 7.5%. So I have taken directly multiplying all three of them. So you first multiply all of them. Okay. That is basically you do 1.06 raised to 5. Then you do 1.065 raised to 5. And then you do 1.075 raised to 5. Okay, you will get here, you will get the answer as 1.3382, then 1.37009, and here you will get 1.43563. Multiply all three of them. First multiply all three. 1.3382 into 1.3709 into 1.43563. You will get this 2.6322. Then multiply that by 1 lakh, it will be 2,63,220. Okay, I'm giving you 30 seconds just to go through this sum again. If you all have not copied or written it, just write it. Okay, I'll explain the question once again. They are telling me to find the future value of rupees 1 lakh for next 15 years. But the rate for the next 15 years is not same. For first 5 years, the rate of return is 6%. Next 5 years, it is 6.5%. And then the last 5 years, it is 7.5%. Okay, so my discounting rate R is changing. So my first 5 years, my R is 6%, next is 6.5 and then 7.5. So I cannot use this one single formula and find it. You can do that way also. You can say first future value is equal to investments, okay, into 1 plus I raised to T. That T will be 5 over here. Okay, so now this 1 lakh, it is going to be there future. In future I am going to receive this rupees 1 lakh. So you can find out for single and then directly add up, or find out for each 5 years. So here again you will do this 1 lakh into, then same thing it is going to come, or else you just directly multiply this by the other rate of interest and get the answer in one go. How much you all will solve? Done, finished copying? Yes, if you will do it differently, you will get a very higher amount. Why? Because then this 1 lakh also you will have to split now. How will you know this 1 lakh? How will you split that 1 lakh? They have not given. Okay, in the first 5 years that what you will going to get the future in, means presently you are going to invest from this 1 lakh. Okay, this much amount you are going to invest. In order to get the future value, find the future value of rupees 1 lakh. Okay, that means my investment amount is rupees 1 lakh. They are not telling me that from 1 lakh first 5 years is for this interest rate with this amount. So obviously if you will do it differently also, you are going to get a different amount altogether. So this is like your uneven rate of return. So you take all the uneven rate of return together and multiply that by the present value, which is 1 lakh rupees, in order to get the future value. Formula remains the same, this only formula. Okay. But the 15 years I have split in 3 different parts, 5, 5, 5, as they have given to me. Now next question, number 12. What will be the future value at the end of the 5 years of $1,000 paying 5% rate of interest? Okay, we have to find the future value. Investment amount into 1 plus I raised to t. Investment amount is 1,000. 1 plus I is 0.05. T is how much? 5 years. Calculate it. This when you will calculate 1.05 raised to 5, you will get 1.27628. So 1276.28. Correct. Okay. One more question. You have borrowed $10,000 from the bank. Okay. And with the understanding that you will pay it off with a lump sum of $12,000 after 2 years. Okay. Okay, 1 minute. Okay, there is some problem in this question. Just mark it cross as of now. Don't do this question. Okay. I will come back to it later. We will first do the future value of an annuity. Okay, now again comes the annuity. Those were the single sum or the investment which is made. Now annuity again same. We have ordinary annuity. We have annuity which is due. Due are your payments are made at the beginning. Annuity ordinary is payments are made at the end of the each period. Okay. So now here ordinary annuity. For an ordinary annuity, the formula to calculate the future value is P. P is the future value of the annuity payments, future value. Okay, PMT is the amount of each annuity being paid into 1 plus I or R raised to N. Okay, minus 1 upon R. This is for the ordinary annuity. In annuity due, there is always one extra period because the payment is made at the start. Okay, so let's understand the sum first. This formula assumes that the interest compounds at the end of each period. Compounding is once only. Okay. Say this. Suppose Arjun invested $2,000 per year in a stock index fund which earns 9% per year for the next 10 years. Okay. 9% for the next 10 years. What would be the closest value of the accumulated value of the investment upon payment of the last installment. Okay, means he is paying this $2,000 he has invested per year. Okay, from the information given in the question, what is your A? Amount investment is 2000, N is 10, R is 9%. Okay, so basically I am finding the future value of a given amount. Future value of the given amount will be the amount, present value means today how much I am investing, into 1 plus I raised to n. 1 plus I raised to n minus 1, the whole thing upon I. Okay, right? So $2,000 per year in the stock index fund. He is going to earn 9% for the next 10 years. Okay, so we have to find out the value of investment upon payment of the last installment, last year, 10th year. Okay, so future value we have to find of this amount of investment. Okay, now I have done stepwise calculation for you all. I did first this 1 plus R, means 1 plus 0.09 is 1.09, then 1.09 raised to 10. That how you will solve is 1.0. It is raised to 10, please. All this n is always raised to. 1.09 into 1.09 equal to sign you will press 9 times. So you will get 2.367. Then I have calculated 1 plus I, the whole thing raised to n minus 1. So 2.23627 we got. Minus 1 will be 1.367. Then simple, then calculating the future value of this amount. Okay, future value of this investment or this payment, it will be amount which is 2000. We found out the numerator, that is 1.367, divided by R, 0.09. So your amount will be 30,385. Okay, therefore the future value of Arjun's investment using the formula is around $30,000. Okay, so $2,000 he is going to invest for 10 years every year. Basically he is going to invest like what, 20,000. Okay, so here the future value is going to become of 30,000, but it is going to take 10 years at a discounted rate of 9%. Okay, same kind of a sum. A company wants to invest $3,500 every 6 months for 4 years. Okay, to purchase a delivery truck. The investment will be compounded at an annual interest rate of 12% per annum. The initial investment will be made now and thereafter at the beginning for every 6 months. So the investment is not yearly, it is 6 monthly, twice a year. What is the future value of the cash payments? Okay, cash flow payments. Okay, here the investment is made at the beginning of each period. So we are dealing with annuity due. Okay, now here annuity due formula differs from the annuity. Why? Because each payment is compounded for an additional period. First only the payment is made. Okay, so it is a little different. Formula remains the same, only you have to take one period extra. So you multiply that by 1 plus R. So the formula remains the same. Just for annuity due, since it is at the beginning of the period, you all know it is annuity due, right? So you will multiply that by 1 plus R. Okay, so the present value, the future value of the given investment, okay, future value of the investment, it is the PMT, the amount to be invested in every 6 months. R over here is going to be twice you are going to receive. No, you are discounting it twice in the year. See, interest rate is 12% per annum, and you are going to do this particular investments once in 6 months. Every 6 months you are going to do it. So therefore you will divide this by 2. You will get 6%. And N, it is for 4 years, but every year twice, no? So your N will become 8. Semi-annual. Since 4 years and payments will be made every 6 months, so you are going to receive payments 8 times. Number of times will be 8. So calculation step by step. Okay, same formula. Okay, same formula. Future value will be equal to the amount. I am writing like this. You can even this is the formula given in your module. Okay, but it is the same thing. Future value of a given investment will be the amount of investment into, it will be 1 plus I raised to n minus 1, the whole thing divided by r. Since it is annuity due, I will have to take one extra period. I am writing I, okay, I am not writing r anywhere. This is also I. Okay, so stepwise, first find the semi-annual interest rate. 12% divide by 2, so you will get 0.06. N is become 8, right? So then I am calculating this 1 plus I raised to n. So 1 plus I is 1 plus 0.06 raised to 8. So answer will be 1.594. Once I get that answer, then minus 1, no? 1 plus I whole raised to n minus 1. So whatever answer I have got, just subtract 1 from that. 0.594. Done. 3500 we know. 0.594 we just calculated. I again we know 0.06. 1 plus I is 1.06. Multiply all of that, you will get 36,719. Calculate it please. I have given you all the stepwise calculation, but calculate again. I will be putting this notes link, okay, in the description. Why I have solved it for you all is so that it becomes easy. Okay, now you may go ahead and refer this from the module also, but what I done is, whatever formula is given in the module, based on that I have just solved it. Their solving again becomes a little bit different here and there, so I have solved it as per the formula which is there. Okay, anything which is critically solving, like where you require a scientific calculator, which is not at all allowed, you can use this Citizen. Only this calci is allowed. Okay, and try to use this Citizen one, because I'm going to show you how to do the capital budgeting also, discount factor on this. So this is allowed. Even in the problems, no, if there is like raised to 32 or something, like, you know, if it is discounted daily 365 and all, they will give you the value. Okay, so then you have to just take the value and multiply it. That's all. You don't have to sit and do 1 divide by 1 point or 1.10 into 1.10 365 times. You cannot do that, right? So they will give you the value also in certain problems. That will save your time. Okay, ordinary annuity due and ordinary annuity I have already explained to you all. Now there is this one last important thing in present value, in the time value of money, rule of 72. Rule 72 basically states that how long will it take, how many years or how much period will it take for a given investment to double at a given rate of interest. Okay, so if I am telling you that I have an investment of 1000 rupees, the discounting rate is, or the rate of return expected by me is 9%, how much time it will take for this investment to become double? directly 2000. So they say there is a very easy formula. Doubling time is nothing but 72 divided by that rate of interest. Okay, that will give you the, not, don't divide by percentage, just take the rate of interest. So this is going to give you the answer basically. Okay, so 70 is an example at a 8% interest rate. Doubling time will be 9 years, no? 72 divided by 8. Okay, if your interest rate is 6, 72 divided by 6 if you will do, then it will take 12 years period. Here it was going to take 72 divided by 8, it is going to take 9 years. 72 divided by 10% if it is the interest rate, it is going to take only 7.2 years for the amount to double. Okay, so rule 72 is one which is important. Then same thing, even rule 69 people use it. It offers a more precise estimate for continuously compounding investment, continuous, infinite times. Okay, so here what happens is, how do you calculate it? 0.35 plus 69 upon the rate of interest. So say rate of interest is 10. So you will say 6.9 plus 0.35. You will just add 0.35 to whatever, 69 divided by the rate of interest. And then 70 also it is the same thing. If you are using rule 70, you will say 70 divided by rate of interest, R. Okay. So generally, if asked in sum, they ask you rule 72. This is the most widely used and asked even in the exams. Okay, so one sum I have taken. Due to the large capital needed to establish a factory and warehouse for coffee machines, Akshay have turned to private investors to fund this expenditure. He is approaching private investors. He met with Jacob, who is a high net worth individual. He is willing to contribute $1 lakh, $10 lakh, okay, to Akshay's company. However, Jacob is only willing to contribute this said amount on the presumption that he will get a return of 12% annually, compounded yearly. He wants to know how long it will take for this investment to double in the value. Simple, you will just take 72 divided by 12, 6 years. In 6 years, Jacob's investment value will double. $10, 10 lakh, 1 lakh, $10 lakh, right? $10 lakh will become $20 lakh in period of 6 years. Okay, clear? Everybody? Any doubt you all have? Understood? Okay, so just a quick understanding and a quick revision basically to give you that why do we do the present value of future value. Okay, so say whenever I am telling you I have ₹1 and the rate of interest at 10%. Okay, so tomorrow the future value obviously will become 1.10. Correct? Why? Because 1 plus 1.10, 1 plus 10%, sorry, 1 plus 10%, that will give me 1.10. Now same thing, if I am asking you that I need 1 rupee in future, how much I will have to invest in present? Simple, cross multiplication. So it will be 1 divided by 1.10. 1 into 1 is 1, divide that by 1.10. So today I will have to have 0.9090. Do plus 10% on this, see, you will get 1 rupee. What? Same thing, that this 0.90. Okay, if it is discounted, what will be the value now, right now, of this 0.90? Cross multiply, same thing. Use this for cross multiplication. Okay. So 0.9090 into 1 divided by 1.10. You will get something 0.8263. Put 10% twice in this 2 years. 2 years. This was year 1, year 2. Do 10% twice. 10% plus 10%. You will get 1 rupee. Okay. So this is the logic behind the present value and the future value. Why we are knowing the worth of the money today and tomorrow. Okay. Understood? Only just to revise certain formulas. Come on. We will all revise together. First, what did we do is, we did simple interest. Correct? Simple interest formula was nothing but you have amount, principal amount, plus into rate of interest into number of years. Clear? Then we did compound interest. I am writing all the formulas for you all. Then we did the compound interest. How will we find the compound interest? Okay, it will be principal into 1 plus r upon n, the whole raised to t, n into t, compounding. Okay, so if it is compounded annually, then it is not a problem, but if it is compounded semi-annually or 4 times in a year, then you will have to do it number of years into the time period. Okay, number of compounding into the number of years, t. Right? Then we did the present value of a future value. You have to find the present value. Present value will be nothing but the future value whichever is given. Okay, into 1 divided by 1 plus I raised to n. This also formula we did, no? Present value of the single amount. Then we did present value of uneven series. That was the cash flow upon 1 plus r, the whole thing raised to n. Okay, then we have to just add up for all the uneven series. Then we did present value of annuity. Okay, present value of annuity is nothing but P into 1 minus 1 plus I, the whole thing raised to minus n, the whole thing divided by I. Okay, in present value of annuity ordinary or annuity due, this is the only formula. In future value it differs because the payments are made, we are finding the future value, no? Payments are made differently at the end of the year, at the start of the year. So in present value, we did present value of single amount, uneven series, and present value of annuity. Then we did present value of perpetuity. Perpetuity. Okay, in that we did standard and growth. Okay, so in standard perpetuity, present value is nothing but the investment amount, right? The identical cash flow upon r. And in case of growth, present value is nothing but identical cash flow upon r minus g. After the present value, we did the future value. Okay, future value of a single amount is nothing but the investments into 1 plus I raised to t. No, 1 into 1 plus I. 1 investment into 1 plus I raised to t. Okay, investments into 1 plus I raised to t, that was the future value of the single amount. Okay, then what was the other thing which we did? Future value of annuity. Future value of annuity, ordinary annuity and the annuity due, it was a little different. In that, future value was nothing but the amount of investment, A or I or PMT as they are writing in the formula, into 1 plus R. Okay, the whole thing raised to n minus 1, this whole thing upon R. Okay, you can write A over here. Amount into 1 plus R raised to n, the whole thing subtract 1 divided by R. And in case of this was annuity ordinary, and in case of the annuity due, the formula changes a little. So it is the same thing. Future value will be amount into 1 plus R raised to n minus 1 upon R, and then here you have to multiply that 1 period. 1 plus R. Done, clear? And then we had rule 72. So in case of rule 72, which is important to know, doubling the amount of investments, so you will just say 72 divided by the rate of interest. You will come to know the number of years in which your amount will double or your investments will double. Everyone clear with me? Any doubt you all have, any question not understood, please ask me now. And this is all in time value, okay? I have taken up everything in time value. There is nothing left in time value of money. Even we will be doing the example questions, past exam questions. We are going to do it. Okay, so whenever they are asking you how long it is going to take for your investments to double, you will use this rule 72. Clear, everybody? Okay. So we are going to take a break and we will resume by 1:30 and we'll start capital budgeting. Okay. 1 minute. You all want a full view of the sums of all these formulas? Yeah, take it here. Starting from here. I have made it from these notes only, like I'm just revising with you all. Okay. So you all also take a break and then come back for here I have zoomed out. You all can take now the screenshot. Okay. You all want me to zoom a little bit? How will you all take a screenshot? Take now two screenshots you all can take. Until future, first finish this much. And then next is this. Okay, taken. Cool, very good. Chalo. So you all also take a break and then we will start with capital budgeting. All right. Bye everyone for now. Hi everyone, welcome back. You all can see me? Can you all see the screen? You all can hear me? If you are, I'm audible, and if you all can see the screen, please just let me know in the chat box. Okay, thank you so much. Okay, all right. Come on. So we will begin with capital budgeting. All right, and then you are going to also solve the past exam questions. So now capital budgeting. Basically, this capital budgeting is one of the strategic planning of an organization, long term planning. It involves capital assets purchased, okay, which are going to be there with that organization for a long period of time, and it is going to give you the revenue for the years to come. Okay, the fruits are given for that assets for years to come. We are talking about the investments done in those capital assets, and therefore the budgeting of capital assets is important. Why? Because it is a huge amount, okay, which cannot be kept doing yearly. You have to do that with a good planning so that you get good returns in the future with the amount invested. Okay, that is the basic simple reason behind doing capital budgeting. Now I have taken a bit important theory to get the understanding. Mostly capital budgeting is a part of your practical questions asked. Okay, so concentrate more on the solving of the problems, even in this and even in time value of money. Okay, now see, it is a planning of capital asset with the object of minimizing the cost so that the profits are at the maximum. Long term implication is involved, and it is a top level management of the company's decisions. Okay, so it can be defined at firm's formal process of acquisition and investment of capital. So we need to know the need of capital investments. Why? Because there is a wear and tear of the equipments, there is obsolescence, they are not running as per the need of the time. Then variation in the product demand, product improvement is necessary. Okay, so change of plant site, diversification, etc. Importance of capital budgeting, long term implications. I just told you it has a effect in the organization for the long period, and it is important for the growth of the organization. Therefore it is a important decision tool, capital budgeting. Involvement of large amount of funds, okay, because of course it involves a huge amount of expense and investment. So if the profits generated are not as much to absorb that expense, the firms will start running into huge losses. It is a irreversible decision. Once you have decided, you had two projects, project A and B, you have decided to invest in project A, there is no coming back. You have put in money in there, correct? Then risk and uncertainty, there is lot of risk involved, with numerous factors revolving around the process of operations of that organization. It is of course very difficult decision to be made, therefore it is made by the top level management. So what do we do with the help of this capital budgeting decisions? Like, what are we using this tool for? Either to accept or reject the proposals and decisions, mutually exclusive the decisions which we can do, capital rationing decisions which are important. Now what is accept or reject? With the help of doing capital budgeting, the firm will know the amount of investment and amount of inflows. That will help them know, okay, if the investment cost is too high and return is not as per the needs, we shall reject, or if it is vice versa, they shall accept the project. Mutually exclusive decisions, it includes all those projects which compete with each other in a way that acceptance of one precludes the acceptance of the other. Whichever you accept, okay, there is going to be a competition in both the, thus some technique has to be used to know which will be the best alternative amongst all. Okay. Capital rationing decisions. Capital budgeting decision is a simple process in those firms where the fund is not a restraint. Okay, they don't have any problem in managing with the funds or borrowing of funds, or they already have internal resources, okay, available. So that for those kind of organizations it's not a problem. But situations where investment is such that they have to take borrowings or they have to get into another mode of accessing the source of capital, then yes, they have to take a very important decision, and a mindful set of all the projects has to be done. Okay, evaluation. Then we are supposed to know importance of net present value and internal rate of return approach. Okay, now internal rate of return means the return which we are going to get on a given investments which we have done in the project. Okay, internally. Externally is the one which is availing in the market. Okay, in the market I tell you that this project, same identical project, is giving a rate of return of 12% in the market. Internal means what is my organization able to give that much return or no? 12% or less than 12% or more than 12%. Net present value, we spoke about that in the time value of money. Okay, whatever investments which we are going to do today, the future benefits which will generate tomorrow, we will find the present value of those future benefits. Okay, so there is certain important points which I have given. We will first do the some. See, now this capital budgeting calculations, sensitive analysis, changes on assumption or estimate at a time to see how the result change. Say for example, a business is expected to earn rupees 500, rupees 1000 and rupees 1000 in first 3 years of the project. Okay, if the business makes an initial investments of 2500, it will recoup its expenses in 3 years, because I will be able to earn 2500 over 3 years. However, the project may perform better than expected, generating rupees 2000 yearly, okay, in the second and third year. Okay, the business will then be break even in 2 years only. They will get a break even, means no profit, no loss. Obviously, any capital decisions which we are doing, not on the first year only, we are not going to get profit in first year. It will maybe loss, but maybe in the second year we get the break even, no profit, no loss. So the third year will be my profitable year. Correct, no? So that is important in the capital budgeting calculations. How will I come to know all this? I'll come to know only when I know my initial investment. Okay, initial investments or my outflow, and I have to compare that with my inflow. How much return I'm going to generate with the help of that outflow which I have made. Okay. Now see, we will just take this first question as an example. Don't read the answers right now. Okay, I'm explaining you capital budgeting in a full-fledged manner with one problem here. Okay, with one question. So your entire concept with capital budgeting will get clear and you will be able to solve any given sum. Capital budgeting is all about this only, which I'm going to solve now. So pay attention. Okay. Suppose a machine cost is rupees 50,000. It is expected to provide the following cash flows at the end of the years. 3 years. In first year 30, second year 30 and third year 30. Should we accept the project? PV factor is 10%. Okay, I will come to the PV factor later on. First we will start with the sum. Okay. Okay. Now tell me one thing. There are different ways, okay, of doing the capital budgeting. Different methods are there in order to or see whether should we accept the project, whether we should reject the project. Okay, so question number 1. Okay, the cost of machine cost, they have told me it is 50,000. Okay, as per method 1, method 1 is known as the net profit method, NP method. What will I see in this is, it is also known as the inflow minus the outflow method. Okay, so first I'll have to find I know my outflow. I'll have to find my inflow for that. How much is my inflow for 3 years? 30k plus 30 plus 30. I'm getting 60,000 minus my outflow 50,000. So my net profit is 10,000. So what will be the decision according to you all based on this method, on net profit method? Decision rule: when net profit is positive, we will accept the project, right? Correct, as per this method. Second, method 2. Okay, I want to know there is one method which is known as payback period. Okay, payback period. I'm doing all the methods in this one sum. Okay, now payback period means what? The amount of investment which I have done in the year 0, T0, my outflow was 50,000. In how many years am I able to get this 50,000 back? Okay, so year 1, 2 and 3. Okay, inflow they have already given me 30,000, 30,000, 30,000. So if I have to do cumulative inflow, so year 1 30, by the end of year 2 I was able to get 60, and by the year 3 I was able to get 90. Correct? Okay, now from my initial outflow or investment, which was 50,000, I have received in the first year itself. Received in first year itself, I have got 20,000. No, sorry, 30. So only 20,000 is remaining. So in how much time will I get that 20,000? So basically, if you see, in year 2, my inflow is 30. But it is over a period of 12 months. So 20,000 I can get it over a period of how many months? When you will cross multiply, you will get 8 months. Therefore, my payback period will be 1 year plus 8 months, 1.8 years. Once again, okay, payback period method means what? That whatever is my initial investment, by when I will get it returned, how much time will I take to get my initial investment back? For that, we know the outflow. They have given us the inflow. We do the cumulative inflow to understand. Okay, with the help of cumulative inflow, I came to know that in first year 30,000 is done. That means 20,000 is remaining. That 20,000 I will get it in the next year. But how much time? 30,000 is for 12 months. In next year's you inflow 30,000 is for 12 months. So 20,000 I will achieve in how much time? In 8 months I'll be able to achieve it. That is how the calculation I will do as a strategic management decision. So my payback period is 1 year 8 months. Now here they decide whether the payback period should be how much, which should be 2 years or 3 years, and based on that then they select the project if they are getting that much. Okay, so payback period differs from organization to an organization. Okay, going to method 3, which is known as benefit cost method. Okay, benefit cost method. Simple, you will say inflow benefit divided by the outflow. So my total inflow is how much? 90,000. Over the period of 3 years, my outflow is 50,000. Therefore, it is 1.8 times. Okay. When the benefit cost ratio, okay, they say that this benefit cost ratio is greater than 1 time, we will accept the project. Accept the project. Clear? Okay. Now this was when I was doing a simple method. I was not considering the time value for this inflows and outflows. Okay, this inflow I am going to get at the end of year 1, end of year 2, end of year 3. So this 10,000 today or this 30,000 in future, what is their present value today? Because my present value of investment I know. Presently my investment is 50,000. Correct. So present value of inflow also I should know. When I am knowing my present value of outflow, I have to compare that with present value of inflow. Only then the decision will be known as the best and the accurate decision. Okay, so now what I will do is same thing. All the 3 methods we will do by taking the PV factor, which is known as the discount factor. Why discount factor? Because now we will time adjustment. Okay, adjusted with time, we will find the value. Okay, so write down, we will do this net present value method. This is net present value. Your inflows and outflows will be brought to their present values, and then you can use any of the methods and take the decision, and decision is taken. Okay, and that the decision is taken. Okay, sure. So as per my sum, my outflow, present value of my outflow is 50,000. Discounted rate, okay, discounted rate is, they have given me, is 10%. So I have to find the net present value. So year 1, 2 and 3, inflow at the end of year 1 will be 30, at the end of year will be 32, it will be 13, and the end of the year 3 also it will be 30. But PV factor, it is known as PV factor, is at the rate of 10%. Okay, so the same explanation which I gave you at the time value of money. What did I tell you with the time value of money? That 1 rupee today growing up at the rate of 10% will become 1.10. Correct? So tomorrow if I want this 1 rupee, today it will be how much? It will be 1 divided by 1.10. Correct? For year 1. For year 2 again you do 1 divided by 1.10. That means you just do equal to sign twice. I will show you how to do it on the calci. Okay. So for year 1, PV factor will be 1 divided by 1.10 you will do. you will get 0.9090 or 91. Round it up. For the second year, you will do 1 divided by 1.10. 2 times you will press equal to. Take your calci. Okay. It should clear all the if any m is there near the 0 or something. Okay, just clear it all this. Okay, if there is any m over here. So I'll do 1 divided by 1.10 because it is 10%, no? 0.9091 was for the second year. I want to continue. For second year, I'll just press equal to. Okay, so for second year, it will become 0.8264. Again, press equal to. For the third year, it will be 0.7513. This same logic you can use and keep doing it. See, keep this the main band, okay, and you can keep solving it. You got this 0.9091 here. Now similarly take this 0.9091. What it will be today? Okay, so 0.9091 into 1 divided by 1.10. 82 cross multiplication when you will do 0.9091 into 1 divided by 1.10. You will get the answer as 0.8264. So I am showing you the shortcut formula. Same that 0.62 in the third year. So what it will be the value over here? Same thing you will do 0.8264 upon 1.10. It will come as 0.7513. Okay, so on the calci, you just have to do equal to sign. First year 1 divided by 1.10 equal to, you got 9091 equal to 8264 equal to third year it will be 7513. Okay. Chalo, so now multiply that by the current value. I got the future value of 1 rupee. So 30,000 it will be PV inflow of each year. Just simply multiply. You will get 27,273. This is 24,792 and this will be 22,539. Add them all. Total it is going to be 74,604. 74,604. Therefore total, okay, NPV, net present value, net profit method, no? Net profit method we are doing, no? So it will be total inflow upon outflow minus outflow. So my inflow is 74,604, outflow is 50,000. So my net profit is going to be, or net present value method, net profit is going to be 924,604. It is positive. So you can accept the project. Method 1. With the same thing I will do the method 2. Discounted payback period, it will be known as. Discounted payback period. First was only payback period. Now I am doing discounted payback period. Write it down here. 1, 2 and 3. Inflow, just take it from top only. Whatever we have done, no inflow here. PV inflow, discounted inflow. Okay. So it will be 27,273 Second year it is 24792 and 22539. Make this cumulative. So first year will be 27273. Next year will be 27273 plus 24792. It will be 52065. Third year will be 52065 plus 22539. So it will be 74604. At the end of the third year, I'll get this total. Okay. So my initial investment is 50,000. From that, in the first year, I have already received 27,273. So balance is 22,727. Okay. Now that I will get it in my second year, no? 22,727. See, in second year it is 24,000. I want 22,000. So in the second year, 24,792 is for 12 months. 22,727 will be for how many months it will take? 11 months. Therefore, payback period, discounted payback period will be 1 year and 11 months, 1.11. Okay. I'll give you all time to take the screenshots you all are taking, right? I'll give you the screen for that. I'll give you 30 seconds. Okay, right now just listen. Understood this? Next is the, we just did the amount, okay, of investment upon inflow divided by outflow. Now that with the discounted method is known as profitability index. They will ask a lot of sums on this. Profitability, this is their favorite. Okay. Profitability index. It is PV inflow upon PV outflow. My total inflow is 74604. Outflow is 50,000. My profitability index is 1.493 times. Okay. We had done no benefit cost method. Benefit upon cost method without discounted period. The same thing. So it has to be more than 1, greater than 1. It is a positive profitability index. In case of discounted method, it is known as profitability index. Benefit cost method. Clear here? Okay. So you all have understood the all three methods: net profit method, then we have the payback period method, and we have the profitability index method with the help of the PV factor, discounted rate factor. The initial three methods I did without PV factor just for you all to see how things change when you take the present value of money in to account. Okay, your payback period was 1.8 months, 1 year 8 months, it became 1 year 11 months. Getting my point? Your present net profit also changed, your profitability index changed. So this is the more accurate way of taking the decision. Okay, come on now, what you all want to copy? I'm keeping this here first. You all have copied all this. This if you all don't copy also it is fine, but then also I'm keeping this. Come on, quickly. Okay, the first one is I have taken wrong over here. It's not 60k, it is 90k. Minus 50k, it will be 40,000 net profit. Oh, so much of difference in the net profit. Net profit as per no taking discount rate was 40,000. But when we started taking the PV factor, okay, the net profit became 24,000 only. Chalo. Copied this. Payback period method. Benefit cost method. Okay. Then we did discount factor. I'm keeping this now on the screen. Next is the discounted payback period. Come on. And then profitability index. Okay. I'm moving to the next question. A company gives the following details. Investment required in plant and machinery is rupees 10 lakhs and working capital is rupees 2 lakhs. Depreciation on straight line method 20%. Salvage is 3 lakhs. Tax rate 20%. Selling price, variable cost and fixed cost. Years and production quantity from that plant and machine. Calculate the net present value and its viability assuming the interest rate is 10%. Okay, before I start the sum, one important thing is that whenever I am doing my outflow, it will be my initial investment. Okay, whatever is my initial investment, it will be there in outflow. Plus the working capital required for bringing that particular project in use. Plant and machinery I bought 10 lakh rupees. But unless I will not deploy my working capital into it, how will I get the production in process? Right. So whenever they have given us working capital, my outflow has to add it up. Working capital you have to add to the outflow. Just do not take only the cost of plant and machinery in that matter. Okay. Then wherever depreciation is given, remember one thing, that depreciation is a non-cash expense. Plus, when it is an expense, it reduces our profit to an extent where we get the tax benefit. Right? Because it is an expense, it reduces my profit. My profit will be less. I will obviously have a tax benefit. Correct? So whenever depreciation is given, we will add the tax benefit on that depreciation. How will we do that? I will show you. Okay. And when all my, when I will consider my salvage values and everything at the last year, okay, in the last year, whatever will be the amount of working capital invested, it will always be the working capital again received. Amount of working capital employed, okay, will be same as the working capital received back after that period is over of 4 years. Okay. So unless it is given otherwise, they might give you two different amounts, then we will consider two different amounts. Otherwise, if nothing is given, I will consider that at the end of the 4th year, my working capital has come back to me. Okay, that is a cycle, no, of operating of the working capital cycle. So the amount invested is amount received. Clear? Now let us start the sum. Okay, slowly I'm going to do this entire question. Okay. Now the total outflow. You all can write it down along with me if you want. Total outflow will be the cost of plant and machinery plus the working capital. So cost of plant and machinery is 10 lakhs plus working capital is 2 lakhs, therefore 12 lakhs. Now I need to know my cash flows. Okay, now my cash flow, cash before tax. Basically it will be my sales minus expenses. Then I will minus tax, I'll get cash flow after tax. Okay, but first I need to know my CFBT, cash flow before tax. So here 1, 2, 3 and 4. Okay, they have given me quantity, they have given me the sales also, no, the selling price. One second. Selling price they have given me variable cost, and they have given me fixed cost 20,000. Selling price is 100, 50 is the variable cost, fixed cost 20,000, and years and quantity 5,000, 8,000, 10,000 and 12,000. Okay, so I am writing this also. Given quantity is 5,000. Then they told me it was 8,000, 10,000 and then 12,000. Year and quantity I wrote. Okay, so now selling price will be how much? Selling price is at rupees 100. So the first one will become 5 lakhs. Then it will be 8 lakhs, 10 lakhs and then 12 lakhs. Clear? Variable cost is at the rate of 50. Variable cost. Okay, so at the rate of 50, so immediately like it is half of it, no? 2 lakh 50, 4 lakhs, 5 lakhs and 6 lakhs. Clear? Fixed cost remains fixed, 20,000. So my CFBT, cash flow before tax, 2 lakh 30 for the first year. Second year it will be 3 lakh 80. Okay, selling price minus variable cost minus fixed cost. Have to subtract. Chalo, I'll write your 20,000. So question will be asked, what is this 20,000? Same fixed cost every year. Okay. So this will become 4 lakh 80. And the last year it is going to become 5 lakh 80. I got my CFBT. Now with the help of my CFBT, I'll be able to find my CFAT. Okay, so again I am writing here year 1, 2, 3, 4. Okay, now CFAT basically see. CF80 will be what? The amount of cash flow before tax, whichever amount of this I have got, I'm just writing it back. 2,30,000. We have got 3,80,000. Then 4,80,000 and 5,80,000. Okay. They have told me tax rate is 20%. That means 80% will be my cash flow after tax. Okay, but I told you there is a depreciation which has a tax benefit given to us. Because of the depreciation, there is a tax benefit which is involved. So 20%, which is the tax rate, okay, is a benefit involved. If I'll make a income statement, no, sales minus variable cost minus minus fixed cost, I'll get my CFBT. From that I will subtract my depreciation, I will get my CFBT after depreciation. Then from there the tax will go. Same answer will come for CF80, but I'm showing you all this as a shortcut because otherwise we'll have to keep making the income statement for each sales level. Okay, so understand this. My CF80 will be nothing but 80% of my CFBT, 80% of CFBT plus 20% of the depreciation automatically. Okay, 20% of my depre, because that much of tax benefit, the rate of tax benefit I'm getting on my depreciation being a non-cash expense and getting my profits reduced. Okay, so I will take 80% of CFBT and 20% of depreciation. For that I need to know my depreciation first. Okay, so in my working note I am writing depreciation. They have told me take it at the rate of 20% on straight line method. So 20%, what is the value of the plant and machinery? Of 10 lakhs. So every year depreciation is going to be 2 lakhs. Correct here? So when I will do 2 lakhs into 20%, okay, depreciation is 2 lakhs for every year. Straight line method it is, not WDV method. Straight line method. So once only I found out the amount of depreciation done. Okay. So my CF80 basically will be 80% of CFBT, which is 2,30,000 into 80%, 1,84,000, and 20% of 2 lakhs is 40. So just add 40, you will get 2,24,000. Then do 3,80,000 into 80% plus again 40,000. Now 20% of 2 lakhs is 40,000 every day. Every year it is going to remain same only. No, so 40,000 we know. Just do 80% of your CFBT and add 40,000 to that. So this will be 3,44,000. Then this will be 4,24,000. And here it will be 5,04,000. Okay, now I have my CF80 with me. My PV factor is at the rate of 10%. Same thing you will do, 1 divided by 1.10. Discount factor rate, 1 divided by 10. So for first year it is 0.9091. Second year it is 0.8265. 8264. And for the third year it is 0.7513. And fourth year it is 0.6830. Multiply them simply. CF80 into PV factor. It will be 2,03,638 Then 3,44,000 into 0.8264, it is 2,84,281. Next is 3,18,551. Fourth will come as 5,04,000 into 0.6830. It will be 3,44,232. But in the fourth year itself, okay, I am going to get my working capital of 2 lakhs back. I told you working capital invested is working capital received. So do this 2 lakhs into 0.6830. 1,36,600. Also in the last year, I am going to get my money by selling that plant and machinery. Salvage value they have given me. See here. Salvage value is rupees 3 lakhs. Salvage, okay. When I am selling it, I am going to get rupees 3 lakhs. But what will happen is, see, plant and machinery, the cost was 10 lakh rupees. Minus depreciation, I applied it for 4 years. 8 lakhs, 2 lakhs per year. For 4 years I did it. Year 1, 2, 3, 4 only we are doing. We are not doing 5th year. So my WDV came to 2 lakhs. Okay. But my salvage, okay, sale, I did it at 3 lakhs. So my profit is now 1 lakh. Right? On this profit, I will have to pay tax at the rate of 20%. Correct? 20,000 will be my tax which I'll have to pay on the profit. Right? But in the 4th year, when I will sell the machine, amount of cash inflow on sale of machine will be 3 lakhs. I sold it at 3 lakhs. I am going to get this 3 lakhs. Just I will remove 20,000 of the tax which I am going to pay due to the profit on sale. Tax on profit of sale. Okay. So 2,80,000 I will get it in my hands. Cash inflow. So plus 2,80,000 salvage. That also I multiply by the 4th year PV factor only, because all this is happening in the 4th year. It will be 191240. Now add up all. Another shortcut method is with 5 lakh 4 add 2 lakhs add 2,80,000. All three amounts add together, you will get 6,72,000. You will get something more. 5 lakhs 4,000 plus 2 lakhs plus 2,80,000. 9,84,000. All this total you can do. Okay. You can add up all these three and directly multiply by the PV factor once, and you will get the amount of all these three in one go. I did it single because I wanted you all to understand it more deeply. Okay. So when you will add all of them, no, you will get rupees 1478,542. Okay, this will be your PV inflow. You can directly do this 5 lakh 4, 2 lakh and 2 lakh 80,000, which is 9 lakh 84,000. Directly you can multiply that by 0.6830 for the fourth year. You would have got here this 3 together would obviously be 672072. You can do it single or you can do it in one go as well. One go is easy, no? So PV inflow I got. I know my PV outflow. Therefore, my net present value method. Okay, PV inflow net profit value minus PV outflow. PV inflow is 1478 542 minus outflow was 12 lakh total. So I'm going to get 2 lakh 78,542 positive net profit. Okay, net present value is positive. So I'm going to accept the project. Clear? Any doubt so far? Okay. I'm going to just explain this CFBT and depreciation part once again. What happens is, when I will do sales minus variable cost minus fixed cost, I'll get my CFBT. From there, I say suppose remove depreciation, I'll get my CFBT after depre minus tax rate. I'll get my CFAT. Okay. What is the sales value in the first numerical sales value? 5 lakhs. Then variable cost was 2,50,000 and fixed cost was 20,000. I got my CFBT as 2,30,000. Depreciation is 2 lakhs. So 30,000 will be my CFBT after depreciation. Tax rate is 20%. Okay. So tax rate is basically, so here I get my CFAT 24,000. Okay, I'm just making the income statement for you. Now what happens is, because of my this depreciation, which is again a non-cash expense, okay, my CFBT reduced, and because of that the tax will also become less. So what if I not done this? Okay, 2,30,000 directly it is my CFBT. Okay, what if I would have not put in my depreciation? My tax rate at the rate of 20%, 2,30,000. So this will become to at 46,000. I'll get 1,84,000. Cash flow after tax. Correct? 1,84,000. Plus if I put my tax benefit I got due to depreciation, Okay, tax benefit which I got due to depreciation of 2 lakhs, which is 20%. This I will add because depreciation is a non-cash expense. Okay, and I did not put that over, I did not subtract that. So if I'm taking the tax benefit, so I will get 2,24,000. So for doing it every single time, if you will do it CFBT, then minus tax, you'll get CFAT, then add tax percentage for depreciation. I gave you all an easy method. What I am telling you is, whatever is the tax rate, put that above depreciation. Balance will be your cash flow after tax, CFAT. But that CFAT for actual cash, when I'm talking about cash inflow, cash outflow, I will not consider depreciation, no. And I will also consider the depreciation because the tax amount of depreciation which is saved, which will now that money will be in my hands. So 40,000 I am going to consider for each year as the tax benefit on depreciation. Add that to my CFBT of 80%. That will give me the actual cash flow CFAT after tax, okay, for the calculation of capital budgeting, not for income tax calculation. Now understood? Who did not understand this chart of 80%, 20%? Now understood? Come on, I'm moving forward now. Okay, next sum. See, outflow is rupees 3,50,000, life is 4 years, CFAT they have already calculated, PV factor is 8%. They are telling me calculate the internal rate of return. Now this PV factor 8% means they are telling you the external rate of return or the cost of capital which is there is 8%. Internal rate of return means what? It is basically that rate of return wherein you have not made any profit, not any loss. At least that much you need. The least rate in return. The least rate of return where there is at no profit, no loss. Nothing is there. Okay, that will be your internal rate of return. If your internal rate of return, imagine, is more than the external rate, it is so good. Okay, you will be able to make the best decisions when you will know your internal rate of return also. So with this sum, we will try to find out the IRR. Question number 3. They have given me everything. I don't have to do much. They have told me PV outflow is 3,50,000. PV outflow is 3,50,000. There are how many years? 4 years. 1, 2, 3 and 4. Cash out, cumulative cash flow after tax. Cash flow after tax, they have told me for all the 4 years, it is the same, 1 lakh. And PV factor is at the rate of 8%, and that also they have calculated. PV factor, no, they have not calculated and given me. They have just told me it is 8%. Okay. CFAT for all 4 years, it is 1 lakh. And PV factor is 8%. Now, since my cash flow is the same, can I find the cumulative PV factor? I can even do the same thing. 8 divided by 0.08. 1 divided by 0.08 equal to 4 times I can do, and I can multiply. Okay, see, 1 divided by 0.08 it will be 1.08. 1 divided by 1.08. So you can do it single or I am doing a cumulative one. I'll show you how. Okay, 1 divided by 1.08. Okay, see, in order to do cumulative cash flow, you can do single years and multiply each year by 1 lakh. So for that, 1 divided by 1.08. Okay, so you will get the first 0.9259. Then same equal to sign only you put it, you will get 0.8573. Again press equal to 0.7938. And then again press equal to, you will get 0.7350. And then multiply 1 lakh by each and every one and you will get the answer. Right, but now since 1 lakh it is remaining the same, no? So I am trying to do the cumulative cash flow for all the 4 years. How do I get cumulative PV factor? First erase all your memory in the calci. Okay, then do 1 divide by 1.08 equal to m plus 4 times, 4 years, no? Equal to m plus 1, equal to m plus 2, equal to m plus 3, equal to m plus 4 times. Press memory recall, you will get the cumulative cash flow as 3.3121. What you will do is, to get this cumulative cash flow, 1 divided by 1.08, okay, equal to m plus, equal to m plus, equal to m plus, equal to m plus, and then press MRC. Okay, so your PV inflow will be 3,31,210. Okay, therefore NPV will be 3,31,000 inflow minus outflow is 3,50,000. 18,790 negative. Okay, now internal rate of return IRR is that rate of return where NPV becomes 0, no profit, no loss. But here I am still in loss. That means I should reduce my discounted factor. Only then my loss will become little less. 8%, I'll make it 6% and I'll see. Okay, this is a, you have to do it, you have to do error find method it is. So step 1 is maximum I will take 2% low or high. Okay, first I'm going 2% low and seeing because I'm already getting negative, no? So here 1, 2, 3 and 4. CFAT is same for all 4 years, 1 lakh. PV factor, make it 6%. Okay, so cumulative how I will find? 1 divided by 1.06 equal to m plus, equal to m plus, equal to m plus, equal to m plus, last MRC. See, do it. If there is any m near your these zeros, clear that first. Press MRC and clear it. Now do 1 divided by 1.06 equal to m plus 1, equal to m plus 2, equal to m plus 3, equal to m plus 4. MRC, it is 3.4651. So your PV inflow will be 3,46,510. See, my loss has reduced now. NPV will be equal to 346,510 minus 3,50,000. 3,490. Okay. So when I'm reducing it by 2%, still I'm getting a negative NPV. I have to find NPV 0. So now I will not go 2% below. I'll go now 2% higher. Oh, sorry, more 2% lower. So here 2% lower at one go, no? So we already went to 6%. Then CFAT is 1 lakh. Still I am getting negative, so I'll have to reduce it. PV factor, I will reduce it and I'll make it 4%. Okay, 2% you can take down. So now how will I get the cumulative PV factor? 1 divided by 1.04 equal to M plus equal to M plus equal to M plus equal to M plus MRC. Karo, you will get 3.6299. So your answer will be 3,62,990. Therefore, NPV will be, inflow is 3,62,990. Outflow is 3,50,000. I am getting a NPV positive 12,990. Now by reducing it by 4%, it has become positive totally. That means they have absorbed this loss also of 3,490. Only then the loss is absorbed and they have become positive, no, after 1,299. Okay, so see this PV factor and amount. All right. When I went 2% low, 2% when we went low, from 6 to 4 we went, na? From 8 we went to 6, from 6 we went to 4. What happened is we got 3,490 loss and we got the profit. Okay, this loss was absorbed and then only this profit was left, no? So basically I'll have to get a total of this. I got a total of 16,480 of profit. Only then the loss was written off and NPV was left of 12,990. So I want to reduce, I want a profit of only 3,490 because I am already at a loss of 3,490 here. I want a profit of 3,490 minus and plus 0, minus 3,490 plus 3,490. It will become 0. So this will be how much? How much will I have to reduce? Okay, so it is coming as 0.3490 into 2 divided by 16480. It is coming as 0.4235. If I'll reduce it by that much, okay, so from 6% minus this 0.4235, you will get 5.577%. At this PV factor, NPV will be 0. You can do it and you can see. Okay, now in the exams, they might not ask you this integrated IRR. They will ask you it is between what. Okay, so as per this sum, we can write that IRR is anywhere between 4% and 6%. Because we did know both. We did at 6% also I am getting negative. Right? And at 4% I am getting full positive 12990. That means when I am trying to reduce my PV factor by 2%, I am making an accumulated profit of 16480. I want to make a profit of only 3490 so that my NPV becomes 0. Okay, so for that how much I will have to reduce from 6? Only 0.4235. Clear? Okay. Okay, now there is this one question which is an it is an accumulation of all and it is like a homework. Okay, you can take a screenshot of this and you can try to solve it. It is also there, this sum I've solved in my the dream batch class also. It is everything like what we did right now. Okay, see, X is planning and capital expenditure of rupees 5 lakhs in the new project and the working capital required is 1 lakh. Depreciation on the total capital expenditure is to be provided in such a manner that the capital cost is written down to 50,000 at the end of the 5 years, which is also its market value at the end. The new project will require use of existing premises which is rented out for 1,000 per month. Expected revenue from the project are, these are your cash flows. 3 lakh 15, 1 lakh 82, 1 lakh 36, 1 lakh 85, 1 lakh 92. Company's cost of capital is 12%. Subject to tax rate is 40%. We have to find NPV, payback period, discounted payback period, both payback periods. Discounted also and the regular one which we did in the first sum. Profitability index and IRR. Okay, I will give you a little bit of hints here. First, your outflow will be of 6 lakhs. Clear? They are saying depreciation has to be written down in such a manner. So your depreciation, you have to write it down in a manner that in 5 years, you are just left out with 50,000 of WDV. After 5 years. That means your depreciation for total 5 years will be 4 lakh 50. 4 lakh 50 divided by 5. 90,000 will be depreciation each year. Okay, correct. WDV and the salvage value, no, market value was also 50,000. Okay, so basically your salvage value or sale value was also 50,000. So there is no profit, no loss. Profit or loss is 0. Correct? This is about the depreciation. This is about the sale of the machine at the end of 5 years. In the revenue, we have to keep one thing important. 3,15,000 is the revenue, but they have not considered this. The new project will require existing premises which is currently rented out for 1,000 per month. That means 12,000 rupees per year is the cost lost. The opportunity is lost. Now we will not be earning this 1,000. So we will only have to pay now from our pocket. So 12,000 every year you will have to remove from the revenue. Okay. So your revenue will be different. Your cash flow will be different. You will be able to do this sum. You will have to do it in the same manner. Your CFBT, here you will take it at 60% and depreciation you will take it at 40%. That you will get a CFAT. Depreciation amount is 90,000 for all the 5 years. 90,000 into 40% is 36,000. That you will add to the 60% value of your CFBT. Okay. So this sum is for homework. You all have to do this sum. And for internal rate of return, you will have to do 2 up, 2 below. You have to see whatever you are getting at 12%. How much is your net present value at 10%? Whether you need to reduce the PV factor or do more PV factor. Okay. Sure. Now we will solve our exam questions. Anybody having any doubt meanwhile can ask me before we start with the exam questions. There is no such formula instead of trial and error. There is trial and error is only the way to do it. Okay, come on. Now let's start with the exam questions. What will be the maturity value of a sum of rupees 18,000 invested today at the rate of 5% per annum for 10 years? Okay, maturity value they are asking me. Sum is 18,000, R is 5%, N is 10%. Okay, so they are asking me future value of the amount. Okay, so amount is, the present value of amount is given 1 plus I raised to N. 18,000 into 1 plus 0.05 raised to 10. So 18,000 into 1.05 raised to 10. How you will solve 1.05 raised to 10? I had showed you all now in the time value 1.05 into 1.05 equal to 9 times you will press. Okay, you will get 18,000 into 1.6289, 29,320. Future value of the sum invested will be this. I have given you the answer also here. Okay, given the effective rate of interest being 9.31% per annum, what is the nominal rate of interest per annum if compounding is carried out quarterly? Okay, let's solve this sum. Okay, first one is your effective rate of interest they have given is 9.31%. Okay, actually effectively, that means it is 0.0931. Then compounding is done quarterly. We are supposed to find the effective rate of interest. For this there is a formula same like that, compound interest rate. It is 1 plus I upon N. Okay, the whole thing raised to N minus 1. In order to find the effective rate of interest, we will find the compounded rate of interest minus 1. How will we come to know this? Effective rate of interest is already given. Okay, we need to find this I. We don't know this I. Okay, so it will be 1 plus I. N is compounded how many times? Quarterly. It is compounded quarterly. Compounded quarterly. That means 4 times. So N is 4. Clear? Now what am I doing is 0.0931. This minus 1 I am taking here, plus 1. So this will be 1 plus I upon 4, the whole thing raised to 4. This will be 1.0931. If I want to remove 4, okay, from here, I will have to do 4 root of 1.0931. So basically 4 root of, it will be 2 times the square root, no? Only then it will get the 4 root. It will be 1 plus I upon 4. When I am removing 4 from the other side of the equal to sign, raised to 4. Okay, Here it will become square root of it twice, means you have to do square root twice. So on the calci take 1.0931 square root. 2 times just press square root. 1.0225. And here I am making the numerator same. It will be 4 plus I upon 4. Taking the 4 on the other side, the denominator 4 on the other side, 1.0225 into 4, 4 plus I. This will be 4 into 1.0225, 4.09 minus 4 will be I. So 0.09 is equal to I. Therefore, rate of interest is equal to 9%. Copy it or take a screenshot quickly. Okay. Chalo next. Third one. Dash is the present value of the asset if the annual cash inflow is 1,000 rupees for next 5 years and the discount rate is 15%. Okay, we just did this, no? Cash inflow is 1,000 rupees. Discounted rate is 15%. Okay, so PV factor is 15%. So I want to know the cumulative PV factor for the 5 years. I will do what? 1 divided by 1.15 equal to M plus 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 MRC. 5 times I will do it. Okay, I'm doing it here. Annual cash flow is rupees 1,000. PV factor is 15%. Okay, N is 5 years. Okay, PV factor 1.15 equal to M plus equal to M plus MRC. You will get it 3.352. Simply multiply that by 1,000. You will get 3.352 as the answer. Next question. The effective rate of interest for a sum of money compounded quarterly is 12.55. What is its nominal yield? I already did this sum. Okay, so this is like kind of a homework. You all can practice it. Chalo, next sum. The effective homework is done. No, fourth one. Chalo. Fifth one. Price of the share is rupees 100 today. It grows to 125 at the end of first year, then 187.5 at the end of the second year, and rupees 243.75 at the end of the third year. What is its average rate of return? Okay, so basically question number 5. Okay, first year P0 is 100 rupees. In the first year it is becoming 125. So I can know the rate of return, no? First year's return, it will be the difference upon the P0, P1 minus P0 upon P0. This will be 25%. Second year it has grown up and it has become 187.5 from 125. It is 50%. And in the third year it has become 243.75 from 187.5. So this has come at 30%. So the average rate of return will be equal to 25 plus 50 plus 30 divided by 3. It will be 35%. Come on, take a screenshot. Fifth sum. Question number 5. Question number 6. What is the present value of an annuity of rupees 15,000 starting immediately and paying another 5 annual installments? Assume a discounting rate of 12%. Nothing, just simple you have to do. Okay, first you will find the PV factor is 12%. Okay, so 1 divided by 1.12 equal to M plus, you will do that 5 times and you will do MRC. You will get that 3.6047. Okay, so 15,000 into 3.6047. You will get into 3.6047. 54,070 54,070.5. Okay, now this 15,000 is starting immediately, T0. You will have to add this 15,000 in order to come to know at the end of the 5 years how much you will get, because you have already paid, no, you have already invested this 15 and paying another 5 annual installments. So for that another 5 annual installments, I found out the present value for that 15,000. But right now I need to know the total amount. It will be 69,070. Okay, you all have to understand the question also. It is all the same thing what we have done, but it is just a little tricky here and there asked. Sure. Next question. Question number 7. If an investment of rupees 3 lakhs pays 25,000 per annum in perpetuity, what is the net present value if the interest rate is 9%? Present value of the perpetuity. I had told you, no, 25,000 is the cash flow. Divide by rate of interest is how much? 9%. We had done that perpetuity one sum, 27,777. This is my inflow, 2,70,000. 2,77,777. That is my inflow. Outflow is 3 lakhs. So inflow minus outflow minus 22,222. Perpetuity it is. Okay, what is the net present value if its interest rate is 9? We don't know N, no? So directly the amount of cash flow divided by the rate of interest. That will be my inflow. Subtract that from outflow, I am getting negative. Next sum, question number 8. A sum of rupees 50,000 is invested at 12% per annum for 6 years. What will be the present value of its maturity value, assuming the required rate of return is 10%? Okay. So basically, question number 8, I am solving it here. Maturity value. Okay. It will be some whatever in present value plus 1 plus I the raised to n. It is 50,000. 50,000. Sum is 50,000, 12% and 6 years. Okay. So 12% means 1 plus 0.12 the whole thing raised to 6. So 50,000 into 1.12 raised to 6. When you will solve this, you will get 98,700. Okay. We have to find the present value of this maturity value, of this future value, at the PV factor of 10%. No? At the required rate of return of 10%. I have found out the maturity value. What will be its maturity value? I came to know because I know my sum invested for a period of 6 years at 12%. I am going to receive 98,700. But they are asking me the present value of my this maturity value. So maturity value to I got samjha. Now the present value will be what? This 98,700. I have to do it at a discounted factor of 10% for the 6th year. Okay, discounted factor at the 6th year. So 1 divided by 1.10. 6 times press equal to sign. 1, 2, 3, 4, 5, 6. Okay, you will get 0.6th year. So 1 divided by 1.10 equal to, you press 6 times. You will get the PV factor as 5644. So 98,700 into, because this 6th year I am going to get, no? So 6th year's PV factor at the rate of 10%. For that I am finding the present value. So it will be 55,667. You solve all these exam questions after I have finished solving once again, okay? You will be able to then understand it better, and this similar type of sums come. Even for the new syllabus, they ask this type of questions only. You have to solve and show it, okay? Firm A is considering a project. The project involves cash outlay of 50,000 at year T0. Working capital is 20,000 at the end of year T2. It is expected to generate a cash flow after tax of 12,000 per annum for 5 years, excluding working capital release back. Terminal value of 20%. What would be your advice to the company in using the net present value approach if its capital is 10, cost of capital is 10%? Okay. So first is my outflow. At T0 it was 50,000. And then working capital was 20,000 at T2, year 0 and year 2, for 2 years. Okay, and then cash flow after tax also they have given me, it is 12,000 per annum, and the discounted terminal value, sale value, okay, 20%, 5 years, and PV factor they have given me is 10%. So my PV outflow, basically PV outflow will be 50,000 the year T0, but working capital was done at year 2, the 20,000. So I'll have to take the second year's discounted factor at the rate of 10%. Okay, so 1 divided by 1.10 equal to 2 times you press at the end of year 2, 0.8264. So actually my outflow is not 70, but it is 50,000 into 50,000 plus 16,528. Okay, So here you get 66,528 as your PV outflow. Now PV inflow. Inflow is simple. Cash flow after tax is 12,000 per annum for a period of 5 years. So you find the cumulative cash flow. How you will do cumulative? M plus 1. Okay. 1 divided by 1.10 equal to M plus 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 MRC. Do that. 1 divided by 1.10 equal to M plus 1, 2, 3, 4, 5 MRC. You will get 3.791. Okay. So my cash inflow, PV inflow will be 12,000 into 3.791. That will be equal to 45,492. But at the end of the fifth year, there is a terminal value of 50%. So 20% terminal value. So I'll get the terminal value, sale value, residual value, okay, which is 20% of my project value. So 20% of 50,000. 50,000 into 20% means what? How much it will be? 10,000. I will take the fifth year PV factor. Last year, no? So 1 divided by 1.10, press equal to 5 times. 1, 2, 3, 4, 5. Okay. 0.621. So this will be 6,210 plus 45,492. 210 plus 45,692. You will get 51902. Okay. Plus working capital released. How much was my working capital invested? 20,000. PV factor of the 6th year I already found 0.621. Okay. So that is coming to 12420. So the total will be now 64122 inflow. Total PV inflow. Okay. So cash flow after tax plus your residual value plus your working capital release 64122 is my inflow, and my outflow is 66,528. Outflow is more than inflow, therefore reject the project. This was an MCQ sum. This can surely be asked as a sum for your solving. Okay, question number 9. I'm moving to question number 10. A firm expects a NPV of rupees 8,000 if the economy is exceptionally strong. 30% profitability. NPV of 4,000 if economy is normal, 40% is the probability. And NPV 2,000 if economy is exceptionally weak, 30% of its probability. Expected net present value is how much? Okay, now this is a little different type of sum, but very cute and very easy. Okay, write down question number 10. NPV and the probability. There is year also, no? Year 1, 2, 3. NPV. No, it's not year. Net present value only. Don't write year. Just write NPV. First, they have given you 8,000. Then they have given you 4,000 of NPV. And then last, they have given you 2,000 of NPV. Okay. Now, they are telling you that the probability of having 8,000 as the net present value is 30%. Okay, 30%. Probability of having 4,000 of the net present value is 40%, and again 2,000 is 30%. Correct? Probability. Therefore, expected NPV 8,000 into 30%, 8,000 into 30%. It will be 2,400. 4,000 into 40%, 1,600, and this will be 600. So the expected NPV will be 4,000. Okay, so read the question once again. A firm expects an NPV of 8,000 if the economy is strong, that is the 30% is the probability. Then the NPV will become 4,000 if economy is normal. To be normal economy, it is a 40% of probability, and 2,000 if economy is weak, which is again a 30% probability. So I will take percentage of each of the NPV to find out the expected net present value. Answer is 4,000. Okay. Come on, now the next sum. What is the present value of the maturity value of rupees 10,000 which has been given on 15% of interest for 5 years while the required rate of return is 10%? I just did that sum. We did this sum some time back. Chalo, we'll solve it again for you all to get more practice. 11th sum. Okay. We have to find the present value of the maturity value. Okay, first thing though, I'll have to find the maturity value of that sum. Sum is 10,000, no? Rate of interest is 15% for 5 years. So 10,000 into 1 plus I raised to n. So 10,000 into 1 plus I is 0.15 raised to n is 5. So when I'll calculate this, I'll get 10,000 into 2.01136. So it is 20,113.6. Now present value of this maturity value at the factored rate of 10% for 5th year. Okay, so at the end of the 5th year, 20,013.6. At the end of the 5th year, 10%, 1 divided by 1.10 equal to 5 times I will do. This is not the formula. I am just showing you how to find out the PV factor. Okay, so PV factor, how I will find 1 divided by 1.10 raised to n only this is, but 5 times I am solving it and I am showing you. They just take the 5th year. It will be 0.6209. So the answer will come as 12,488.94. Present value of the maturity value. Clear? Anyone is having any doubt so far? Yes, you can use the PV annuity formula also. PV, present value, future value formulas also. You all can solve the way you think you can get the answer. It is not a problem at all. If there is any questions, please don't feel shy to ask. Okay, you ask whatever it is, I will get back to you on it. You can even use the present value formulas. Okay. Now the next question. MNP Limited is considering purchasing of an asset costing rupees 80,000 and having a useful life of 4 years. During the first 2 years, the net incremental after tax cash flow was 25,000 per annum, and for the last 2 years it was 20,000 per annum. What is the payback period for the investment? Now they have not given me any discounted cash flow or something. Okay, so this I will solve it in a easy way. Okay, average annual, I'll just find out the average annual cash flow after tax. They have told me for the first 2 years it is 25,000, and in the next 2 years it is 20,000. Okay, divide by 4. 22,500, it is on an average. Okay, I am showing you the payback period formula with the help of this. We have done payback period with how I showed you that do the cumulative, and then also you can find the answer. So you can do year 1, 2, 3, 4, and then you can find cumulative also and get the answer with that as well. Not a problem. Same thing. It's not going to differ. Okay. So you can do a cumulative cash flow and then in how much you have finished in year 1, year 2. This I am doing it in a formula based method. Average I found out. Okay. Internal initial investment. Payback period will be nothing but initial investment upon the average. Initial investment was 80,000. Average is 22,500. So it will come as 3.5 years. This formula you can even use it in the sum which I had also done. Average was 30,000, no? So average 30, 30, 30. 30 divided by 3. Average was 10,000. So that also you can do initial investment divided by average. You can use this formula or you can use it as per year 1, 2, 3 and then cumulative, and then also you can find you will get the same answer. I am showing you the both method. Okay, for those who are doing MCQs or anyone, whoever is doing whatever, before solving it fast and quick, I am showing you both the methods. Come on. ABC project has the following cash inflows for 4 years. They have given me the initial investment is 1,04,000. Find the correct statement from the following. Present value of an annuity of a rupee of a various discounting factor in the 4th year is. Okay, now they have given me cumulative. In the 4th year, this is wrong. You will do it 9%, no? This, you don't use this table. It is this something, there is some mistake in this question of this particular table. It is not in the 4th year. Cumulatively for the 4th year it is. Total. Okay. So now what have I done is that we have to find the IRR related answer. Okay, IRR is when the NPV is going to be 0. So what have I done is year 1, 2, 3 and 4. Okay, amount which they have given us is 34,444. Year 2 is 39,877. Year 3 is 25,000. Year 4 is 52,800. Okay, they have given me this table. I am trying to take a PV factor and understand how much NPV. You can take any. I have started with taking, see, there is one is less than 9%. One in the MCQ was 9 and 13, 16 and 18, and one was 17. Okay, so I started only with 16%. Okay, I'm showing you why, because it was not there any other, this was not there in the MCQs. Okay, 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% 16% Question number 13. PV factor at the rate of 16%. For each year when you will do it, no, you will get it 0.862, 0.743. The one which they have given, we could have used that if the amount was same all the years. Say it was 1 lakh for all the years, or it was 2 lakhs for all the years. I would have directly used the 16% amount and solved it. Okay. 29,691, 29,629, 16,025, and then you have 29,146. So the total is 104491. Okay, and our initial investment is 1,04,000. So basically we are at a profit of 400, no, 4, yes, 1,04,000 was the initial investment, right? So we are at a profit of 4191. 1,04,000 minus 491 is a profit. Okay, profit is 491. So basically I want to reduce it more. So I will take it 17% and then I'll take it 18%. I'll try to find out with that. So basically it will be somewhere between, if you do it with 18%, you will get a really less amount, you'll get a loss. So I have just mentioned it here that the PV factor will obviously be between 16% but less than 18%. 9% and 13%, you'll get a high amount of profit. You can solve this for practice. Yes, I could have taken this PV factor if they would have given me the similar amount. Directly I could have taken this and solved it. But it is not possible with this. Mohan Pizza Limited is considering of purchasing a pizza oven. The expected purchase price is 2,70,000. Expected annual revenue from the oven is rupees 1,50,000 and expected annual cost are 90, including 22,500 of depreciation. The investment has a payback period of how much? Okay, now they have not given me any tax rate and etc. anything. So annual cash inflow. One, they have given me my annual revenue. From that I will minus my annual cost also which they have given, and depreciation is a non-cash expense. I will add that back. Okay, so annual revenue is 1,50,000, 90,000 is my cost, and depreciation is 22,500. So my annual cash flow is around 82,500. They are asking me my payback period. So payback period will be nothing but investment upon your inflow. This cash, annual cash flow. Investment is done of 2,70,000 of that pizza oven. Divide by 82,500. You will get 3.27 years. Okay, non-cash expenses is added back. It is not an actual cash outflow. Okay, now the question number 15. ABC Limited has an estimated cash flow cash inflow of year 1, 2, 3 as 500 lakhs, 1200 lakhs, 1500 lakhs. Probability success is 0.7, 0.65, 0.75. PV factor at the rate of 10% for 1 year, 2, 3 is already given. Estimated initial investment is 1500 lakhs. The expected NPV is how much? So first write the year 1, 2 and 3. Okay, then they have given you the cash flows in lakhs, 500, 1200 and 1500. And they have given you the profitability, profitability of success, means they have given you the probability of this success, like how we did that sum of 30%, 40%. So probability of the profit is given to me as 0.7, 0.65 and 0.75. Okay, so here I will get my actual cash flow. So this is going to be 350. You have to multiply it with the probability. This is going to be 780 and this will be 1125. Multiply by that the PV factor which they have given me, 0.909, 0.826, 0.751. So PV inflows will be multiplied 318.15, 644.28, 843.75. Total will be 1806.18 inflow, and outflow is 1500 lakhs. So NPV will be equal to 1806. It is 1806. So 1806.18 minus 1500 lakhs, that will give you 306.18. Next sum, question number 16. Initial investment required for project A and B is 1 lakh. The present value out of future cash flows from project A is 1,15,500 and B is 1,19,500. Profitability index of both the projects will be how much? Okay, so basically how do I find the profitability index of A? It is the amount of inflow which they have given me is 1 lakh. Profitability index is the benefit upon cost. Okay, so benefit is 1,15,000, cost is 1 lakh. So this is going to be 1.155, and profitability index of B. Okay, benefit is 1,19,500 and cost is 1 lakh. This is coming to be 1.195. So this was the answer. Initial investment of a project requires 5 lakhs. Expected annual cash inflow is rupees 90,000 for 10 years. Okay, so they are determined the payback period. Nothing, simple. Payback period, it will be how much? It is 5 lakhs rupees. On an average they are going to give me cash inflow for 90,000 10 years. Same amount of cash inflow in 10 years. So 5 lakhs divided by 90,000. Okay, it will be 5.55 years. Okay, now 0.55 years, since they have asked in months form, just multiply that by 12. You will get 6.66. 6.66 months means approximately 7 months. So you can say 5 years plus 7 months. Okay, when you do 0.55 into 12, you will get 6.66 months. Okay, so that is approximately 7 months. Question number 18. GRI Company Limited decided to invest in plant and machinery 650 lakh rupees. Okay, and life of the asset is 5 years. At the end of the 5th year, estimated residual value is 3 lakhs and disposable expenses is 1 lakh only. Estimated cash inflow is 75, 90, 110, 125, 140 lakhs respectively. PV factor for 9 years, for 1 to 5 years, 9%. They have already calculated and given to me. Calculate the NPV. Okay, so I'll solve this sum. Question number 18. Okay, initial investment is 650 lakhs rupees. Number of years is 5 years. Okay, residual value was 3 lakhs rupees, and there is some disposable expenses of rupees 1 lakh. Okay, all given, I'm writing. Now here 1, 2, 3, 4 and 5. Then they have given me the inflow 75, 90, 110, 125, and your fifth is 140. Okay, then we have the PV factor at the rate of 9%. They have given me 0.9174, 0.8417, 0.7722, 0.7084 and 0.6499. Okay, simply multiply them. For the fifth, last year I will show you about the residual value and everything. I'll get 68.805. Then this is 75.753. Then 110 into 0.7722 is 849.42. Then we have 90.986. No, 84.922. 84.942. And then the last one is 1.2998. But in the fifth year, we don't have to forget, in the fifth year, we have at end of the fifth year, this 140 inflow is there, but there is a residual value of 3 lakhs, and to get that residual value, there were disposable expenses which I had to do of 1 lakh rupees of this plant. So basically I got another 2 lakhs in my hand, rupees in lakhs. At the end of the fifth year, this is my PV factor. So when I will multiply this, I have done something here not correct. Just multiply this 125 into 0.7084. It will be 88.55. Here 88.55. Then 140 into 0.6499, that will be 90.986. And then 2 into 0.6499, into 2, it will be 1.2998. Okay, total all it will come to 410.33. This is your inflow. Outflow is how much? 650. Therefore net present value is minus 239.66 here. Okay, next sum. Ravi and Sam invested in equity market of rupees 2 lakhs each, and Ravi invested it in manufacturing sector, Sam invested in IT sector. Okay, at the end of the year, overall yield from the manufacturing sector was 4.75, from IT sector it was 7.25. Alternative bank interest yield was 6.75% in the term deposit. So what was the gain or loss to Ravi? Now understand this question. There was one alternative of keeping your money in the bank where you would have got 6.75. But what did Ram do? He invested in equity. Sam also invested in, Ravi and Sam both invested in equity. Ravi went in manufacturing sector and Sam went in IT sector. Okay, so they have given you all the return in each sector. Okay, so now they are just asking you कि what is their profit or loss. So basically for Ravi it is, he has invested 2 lakhs. He is getting 4.75. Otherwise he would have got in bank 6.75. So if you just do 2%, means 4.7, 6.75 minus 4.75 is 2%. So 2 lakhs into 2%, 4,000 is the loss of Ravi. Okay, and for Sam, okay, IT sector is giving 7.25. So 2 lakhs, 7.25 minus 6.75. So 2 lakhs into 0.5%, which is 1,000. So it is basically Sam has got 1,000 of gain. Clear? Next question. Shaktiman Incorporation considering a project that requires rupees 4 crores as initial investment. It is expected to generate annual after tax cash flows as rupees 60 lakhs for 12 years. Shaktiman's weighted average cost of capital is 14%. Project's net present value and approximately IRR will be how much? Okay, net present value so I can find, no? It is 14% PV factor. Okay, for a period of 12 years. Okay, cash flow remains same, 60 lakhs. So I can take a cumulative PV factor. So I'll do 1 divided by 1.14 equal to M plus 12 times and then press MRC. Karo. 1 divided by 1.14, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. When you will do this, you will get 5.66. So 60 lakhs into 5.66. $339.6 is the inflow. Outflow is 4 crores. Basically 400 lakhs. So 60.4. 60 lakhs 40,000. Negative. That also. Net present value is negative. I'm getting less of net present, the income. Inflow is less than the outflow. And what would be their IRR, internal rate of return? Imagine 14% they are getting at 14%, they are getting the negative present value, negative cash flow. Okay, negative net profit is not there only. In fact, they are running at a loss of 60 lakh 40,000 at 14%. That means they will have to reduce their discounted factor rate. So now as per the sum and as per the MCQ, this is the only option left, no? A. Their IRR will be 10%. Here only they will have this NPV as 0. Otherwise they are running in loss. Okay, net profit, no loss will be only at the rate of 10%, because at 14% they are running at a loss. Okay. Find the amount of an annuity if payment of 50,000 is made annually for 7 years at an interest rate of 14% compounded annually. Okay, so annuity formula of the future value. So future value will be amount 1 plus interest, the whole thing raised to n minus 1 upon 1. Amount is 50,000. I is 14%, so 0.14. The whole thing raised to 7. Solve this 50,000. 1.14 raised to 7 minus 1 upon 0.14. Okay, so 50,000. When you will solve this, you will get 10.7307. So after 7 years, this 50,000 at the rate of interest of 14% will become 5,36,500 approximately. The present value of rupees 1,000 to be received after 1 year at the rate of 8% per annum is 926 if discounted half yearly. The present value will be how much? So present value will be equal to the future value into 1 upon 1 plus I raised to n. Future value is 1,000. 1 upon 1 plus I means 8%, no, 0.8. Or I'll write it by, they all will say from where it has come. 1 into 1 upon 1 plus 0.08 raised to n is, if discounted half yearly. Oh, okay, it is discounted half yearly, so make this 4%. Half yearly, so 8 divided by 2 will become 4%. Huh? So 0.04 and n will be n into t. Okay, after 1 year, no? So 1 year into 2 times. So this will be 2 only. So 1,000, 1 upon 1.04 raised to 2. 1 divided by 1.04 equal to 1,000 into 0.924. So 924.55 is the answer approximately. Clear here? All of y'all? Okay, so it was a very lengthy chapter. I have tried to finish as much as I can. Okay. You all can try all these exam questions with the PV formulas also. You all can try it the way I have given it to you also. It is not possible for me to complete and show you each and every way. I have already done time value of money. You already have all the formulas. You have those formulas. You can use the PV annuity formula also. Someone is asking me, why am I not using? It is nothing that, see, there are many different formulas are given in your module. I am using those only. Different for the K7 questions given. You are going to get the same answer. You want to do more practice, you can solve this keeping that formula of time value of money and then solving it in that manner only. Okay. So this was it with FM marathon. All right, I have solved all the important questions with for all the important chapters. So next week I will see you all with the corporates and corporate accounting important chapters and all the exam questions. Okay. Bye everyone.